Alrighty. Good morning, everyone. Welcome to your last hall for PMAC. Just a few little rules or protocols before we get started. If we have any issues, those of you who may have joined on a previous occasion, you know we had a few, I don't know if it was Wi-Fi or Teams issues, and then we had to cancel the whole process because it was in and out and in and out. So what we'll do is we'll make a set of rules now. If this happens again, what we'll do is we'll give it 2 tries. So we'll go out, we'll come back in, and we'll see if we can get it after about 15 minutes, see if it's operational. If it's not, then we call it quits, and then I do exactly what I did last time. I complete the recording for you. We distribute it as we would normally distribute the recording in any case, and you would then have the slides and the recordings available for you to use at the weekend. Because I know some of you have taken time out now from some of your other modules, which are exams that are happening before economics. So you don't want to waste time on something that isn't going to give you some benefit. Also, you'll see that I said here part 1, Learning Unit 6 to Learning Unit 7. So I've done it in 2 sets of slides, also just to make it a little bit easier, because I think perhaps that's also some of the problem is when our slides are just too many. So we will do Learning Unit 6 through to 7. I will then stop sharing. I will then upload the next set. You then can also decide what you want to do. If this is the part that you want and then you decide to book off when we finish this, that's also absolutely fine. Remember, this is entirely for your benefit, so you must use it as you think it is suitable for your own purposes. Then the next thing that I just want to remind you is just to keep your questions to the specific learning units. All right. We will get to all of them, and I will be able to answer questions from any learning unit, but it's just much easier for you and for me if we just keep it to the area that we're busy with. All right, so let's get started. Remember, you can't use your mic, but you can send me chats regularly as you find things that you may want to re-ask, or if I'm going a little bit too fast and you missed something, you can always put it in the chat, and then I'll try and go back to what it is that you missed. Let's have a look quickly at what I've said here. What to do now, obviously, to prepare for the exams. Well, many of you already know, but this is a little bit of advice for those of you perhaps who are very first time studying at a first year level, and particularly for economics. And for PMAC, it's very similar to PMIC. So the methodology that you used in PMIC should work also for macroeconomics. But what we find sometimes is that with micro, you have to do less work, because if you've understood it, you kind of remember it quite well. Whereas with macroeconomics, economics 1B, you have to actually spend a lot more time learning the material. So please remember that we're not going to ask you stuff that is not prescribed. We ask everything that is prescribed. The problem is, did you study everything that was prescribed? That's going to be your question or your concern at this stage. Remember, the exam covers all the learning units, and that is learning unit 1 through to 11. And in your textbook, that's chapters 3 and then chapter 13 to 22. Remember, we redo chapter 3, which you did in first semester. We redo it in depth for second semester, and then we test you on that as well. And then your very last point is, or my very last point is, when you are studying, try and be patient. There's a tendency for all of us to want to zip through stuff. And we tend then to ignore things that we should have paid attention to. So being patient, work through difficult sections carefully, but then also don't forget to learn the easy sections. Sometimes those are the ones you think you know, and then in the exam you find you don't know. So just being careful and thought or mindful while you're studying is important. Yes, Mohammed, we will be having a formula sheet. I will talk a little bit about that with Learning Unit 6 and Learning Unit 7. All right, so Kayla, yes, I'm not sure what's going on there, but there may be something on your side, because I think most of the students are seeing the slides. You may need to exit and re-enter. It might be an issue on your side. I'm not quite sure. If you're on your computer, it shouldn't be. If you're on your phone, I think there are sometimes a few issues there. Oh, okay. All right, so it's just reminding us. So the chat is reminding us that I must tell you we are recording this. So please do take note of that. All right, folks, looking at your briefing, which you should have seen. So the exam briefing was uploaded into student material. So please do take a look at it. It does give you a bit of a guide. There is a proviso that says, please be warned that this isn't exact. And it's not exact, because if you add up all those percentages, you're going to get way more than 100%. So the bottom line is we don't know exactly. What we know, though, is we can see where there are going to be quite big questions from. So those questions for 10 marks, 8 marks, are probably going to come from those ones where there is an allocation of a higher number of marks. All right. So watch out for those. Those learning units will be absolutely critical. But, and that's the big but, that does not mean the others are not important. And I always warn my students, go broad first. So know a little bit about everything first. And then what you do is you go in and you focus on some of these chapters or learning units that have allocated a large number of marks, because you know they're going to be in depth. And I'm going to give you an illustration of that in a moment. In fact, right now. So a suggestion on how to study the material. Look, if you're already cracking 80s and 90s, please, you go with your methodology because it's working. I'm talking to those students perhaps who always feel as though they put in the effort and they don't get the results that they should because they're putting in study time and then they're coming up with a mark that they're disappointed in. Now, that may be because the way that you're studying your material is not correct. You've got to get a little bit smarter and a little bit tougher with yourself. And what I always suggest students should do is you first break your learning unit down into the key components. And then what you do is you make sure you've covered each of those key components. So for example, if we look at this learning unit, and we know now that this is one of the most important ones. It was just coincidence because inflation is often an important component of the final exam, that I chose this one. But how would you approach this first? First, what you do is you divide it into its components, as I've just said, and that would be, for example, define inflation. What are the elements of that definition? You need to know how to measure inflation. You must be able to tell us that there are 4 ways to measure inflation, and you should be able to name them all. You need to be able to discuss the effects of inflation. Remember, there's 3 main groups of effects that you must be able to name first and then be able to give examples or recognize each of those different effects. And then, of course, the very big section is, can you draw the graphs and discuss the causes of inflation, demand pull and cost push inflation? Then how to fight inflation, super important. That may be a question all on its own. How do we fight inflation in an economy? And you've got to be able to deal both with your fiscal policy and your monetary policy there. And then inflation targeting framework, folks, that's just learning. If you haven't learned it, you're not going to know it. And then we go to the NBNB, your Phillips curve. So each of these is going to be questioned in some or other way. It might be a short question, a true, false, or multiple choice, but it's going to be there. So you need to know, and then you need to be smart in the amount of time you spend. And what I've urged my students to do is be strict on themselves. Set yourself a time limit. And really, you need to know what that time limit is. For example, if you want it to be 1 hour, in 1 hour, you must finish this. You must cover all of these sections and you must know the key points of it. You can always come back to it later and add information, but you can't afford to be stuck on one chapter for too long and then miss out a whole bunch of other chapters. All right. So hopefully a little bit of advice that might or might not help you, but each to your own. Use it if it works for you and see if it improves your marks. Certainly, if you have been struggling, you've got nothing to lose. What we're doing for today, 9 to 11, we're going to do learning unit 6 to 11. We will take a short break, obviously, in between. And then the rest of the time, I don't know if it'll take 2 hours. It could go quite quickly. We will be working on learning unit 1 to 5. And we will get through whatever we can. Don't want to keep you overtime. Also don't want to keep you if you feel like, okay, that section's not a problem. I'm cool. I'm booking out. Anytime you want to go, we understand. Off you go. And as I say, you can always listen to these recordings at a later stage. Remember, unfortunately, for this particular module, there's just no shortcuts. And that is because generally, as you could see from the exam brief, they spread the questions over all the learning units. As they've indicated to us, there'll be some that are more significant than others, but that doesn't really encourage selective learning. You will get a choice in section C. So you will probably then have to answer 2 out of the 3 questions. We don't know. This is the first time we're experiencing it, so we don't have experience on how they allocate those choices. And we don't know if they break it into learning units. So it might be across all learning units. So please don't think that you can leave out anything. It's just going to jeopardize your chances in that final exam. And remember, you've got a sub minimum of 30%. So even if you're sitting at a really good mark at the moment with your ICE tasks and your test 1 and test 2, remember you've got to get above 30% or 30% and above, otherwise you fail the course outright. So please do remember that you can't aim for, I only need 20% to pass the module. No, you've got to get that 30% or 30% plus, all right? All right, let's get started. I'm hoping that you're all well connected now and you're all managing so far. So good. It seems to be working quite well. We're going to take a quick look at Learning Unit 6 and 7, which is, of course, your Keynesian model. And, of course, this is critical. We know there's going to be a question on this. We just don't know for how many marks and what sort of question, although I've got a fairly reasonable idea what sort of question you can expect. Let's have a look at the questions that have occurred previously. So this is your common type of question. And often this is for 20 marks. As I say, there can be 10 to 20 marks, depending upon how many they ask you and what the mark allocation is. But you're going to get something like this. All right. So you need to be totally comfortable. Now, I know all the lecturers go through this in detail. So I am assuming at this point that most of you are relatively comfortable. And what I want you to watch out for now is that you don't fall into any of the traps. All right. So what we're going to do is we're not going to answer these questions now. We'll get to them at the end, or a similar question at the end. What we're going to do now is have a look at what you should have studied in order to be able to equip you to answer these kind of questions, and then possibly some of the theoretical questions they could ask you in the Keynesian model. Let's take a quick look. There's your first thing. When you studied Learning Unit 6, remember it was called the simple model. Please do watch out for your questions. Do they say the simple model, in which case they are referring to the model in Learning Unit 6, or do they talk about the full model, which is your 4 sectors in Learning Unit 7? Then, just in case you didn't know, the Keynesian model is often also called the goods market model. They can use that terminology so that you can link the two. You know they're still talking about the same thing. In Learning Unit 6, we looked at what we call a simple 2-sector model. That means 2 sectors is just households and firms. When we talk 2 sectors in economics, that's automatically what we mean, households, firms. If we talk 3 sectors, it's households, firms, and government. And if we talk 4 sectors, it's normally an open economy. That is language that we use automatically, and we sometimes forget that students don't know that. Your assumptions and implications that you learn for test 2, folks, still super important. So please do be sure that you have learned them. There's 7 of them. You should remember them now. And then your aggregate spending and autonomous spending. Do you know the difference? Please be sure that you do. Students often get themselves confused because they haven't recognized that terminology. Now, your formula sheet's not going to help you if you don't recognize your terminology. Aggregate spending, without any lines on top. Autonomous, not dependent on income, and therefore has lines on top. All right, so just watching out for that. A little bit more on Learning Unit 6 for you. Your consumption function, do you recognize it? Do you know what it means? So if you're looking at your consumption function, so let's take a look at our consumption function there, and let's remember all those parts. So this tells us that consumption by households in the economy is equal to autonomous consumption, which is your capital C with a line on top, plus showing us a positive relationship between income and consumption. And then CY is your induced consumption, which is made up of your marginal propensity to consume, your little c, and your income. You must know that because they could ask you the question, what are the characteristics of the consumption function? And then that's what they're asking you. So you need to be able to use this little formula or equation to help you remember that. Once again, will be in the formula sheet, but if you don't know what all the parts are, it's not going to help you, all right? The next thing is your relationship between A and Y, specifically in your macroeconomics. Remember, you learned right at the beginning of the Keynesian model to differentiate between the national accounts, where A is always equal to Y, which is A is always equal to, or spending is always equal to income, which is always equal to production. So therefore, A is always equal to Y. All right, that was for the national accounts. But in macroeconomic theory, and that is what we are studying here, macroeconomic theory, it does not have to hold. But, and here's an NB for you, if you haven't made a note of this already mentally, make a note physically now. Income is always equal to production. That is why. So income is always equal to production. That is why, but it is not always equal to spending. If you can get clarity on that, that's going to help you quite a lot in the understanding of the questions that they ask you. And then, of course, we could have three different situations between A and Y. Aggregate spending is greater than the level of income or production, and that is excess demand. Aggregate spending is less than the level of production or income, that is excess supply. And then at equilibrium, we know that those two must always be equal. And then that allows us to go into our formulas, and our formulas are simply to work out what is the level of income when we are at equilibrium. That's what we want to know, because we want to know if we're spending this much in the economy, what does our economy actually look like? What is the level of production and income in our economy? That's what we're interested in. All right, a quick question. Please repeat the statement that we must note. You need to note that in macroeconomic theory, in other words, in the Keynesian model, income is always equal to production, which is Y, represented by the letter Y. All right, so income is always equal to production, and that is Y. But it is not always equal to spending. That is A. If you've seen that connection, then you're good to go, because that is going to help you to be able to understand what the question is asking. All right, so one more time. In macroeconomic theory, income is always equal to production, but it is not always equal to spending, which is represented obviously by the letter A. All right, so moving on to what we next need to be able to do. Would you be able to show equilibrium in a graph if necessary? This is your equilibrium condition, which is your 45-degree line. So if we need to illustrate equilibrium, we have to have that 45-degree line. And then what we do is we bring in our aggregate spending line. Now, normally I would do that 45-degree line as a dotted line, but you don't have to. You can make it a solid line, so I've kept it solid for now. The reason I usually bring it in as a dotted line is it just makes it easier to read the graph. But whichever one you've been taught, that's absolutely acceptable. And then we identify where are we in equilibrium. And of course, we can only be in equilibrium at one point. That is where our aggregate spending line actually intersects with our 45-degree line. So that is what we're interested in. What are we actually talking about here in real terms? This is our spending in our economy. So that red line is indicating for us what we are spending in our economy, and we want to now know where are we. And the chances are, if we're calculating equilibrium, we've identified that this would be where we should be in equilibrium. All right, so that is what it looks like. More often, though, they ask you to calculate rather than what it looks like, but you still need to have a picture in your mind. So you'll see I've got a few graphs in here that I have put through because they can ask these graphs as well. Not frequently, but they do on occasion. So here is one of the things that they expect you to be able to do with this. The question might say to you, what will happen, or explain and illustrate with the aid of a diagram, the impact on the equilibrium level of income if there's an increase in investment in the economy. So we look here and we say, all right, this is where we are at the moment. So now we want to find out what happens if investment spending in our economy increases by 150 million. So what we do now is we go in and we work it out. We can do it mathematically, or we can play around with our graph and see what happens. Now, this tests quite a lot of knowledge, which may not be tested in a graph. It can be tested in theory. In other words, you could be asked to explain what is going to happen when investment increases. And then you would tell us the following. First thing that must happen, or you must understand, is that aggregate spending will increase. And that is because of the increase in autonomous spending of 150 million. So there we have an increase in our level of aggregate spending caused by an increase in autonomous investment, which has shifted the A line upward. What does that mean in terms of the equilibrium level of income? It means that our income in our economy will increase. Now, that should be common sense as well, students. We all know that if there is investment into the economy, we will see an improvement in the performance of the economy. And that's what we're showing you here. All right. So also keeping it simple in terms of your understanding and allowing it to make sense to you. If it makes sense to you, you're going to find it so much easier to remember for that exam. All right, so that's your simple illustrating the multiplier effect. Now let's talk a little bit about the multiplier effect, and that is being able to tell us that that increase in the level of output will always be greater than the increase in autonomous spending. Learn it. Be able to recognize it, be able to describe it if necessary. For 2 or 3 marks, what is the multiplier effect? And simply what I've put in this little box here is adequate. You'd be able to use that as your answer. That was Learning Unit 6, pretty much formed the basis of Learning Unit 7. So we now go into Learning Unit 7, and here, get your calculators and get your pencil and paper ready, because we are going to stop towards the end of the learning unit. We're going to stop and we're going to have a look at whether you are able to calculate some of these things. Just a few checks. I'm not going to make you answer a whole question, but I just want a few checks just to see that people are sort of on the right track and they're able to recognize what the question is asking. So what did we do when we got to Learning Unit 7? We took everything that we'd learned in Learning Unit 6, and we then added first the government sector. So we turned it into a 3-sector economy, and what we did was we first added in G, government spending, and then we added in T, taxation. You've got to know exactly what happens as a result. Let's have a look. So there comes G. Adding G in, there's a lot of, well, there's not that much. If you look on the slide in front of you, there's 1, 2, 3, 4, 5 points that you've got to be comfortable with. If you're comfortable with that, you know this. You'll be able to answer theory questions. You'll be able to answer application questions. All right. So that is what I want you to focus on, is these kind of things that are going to help you to remember the information in the exam. We add G in. What is critical about government spending is that it's an injection. It increases aggregate spending. Remember that. It's an injection into the economy. We learned that in Learning Unit 1. It increases aggregate spending. It does not affect the multiplier, but it affects aggregate spending, it affects autonomous spending, and it affects the equilibrium level of income and production. So 3 things you must be able to be comfortable with. Then we go to taxes. Now, if you're not comfortable with G, then it's really hard for you to see the differences in T. Important, get comfortable with one, and then the second one becomes a little bit easier for you. What is T? T is taxes. So now we're adding taxes into our equation. What do we know about T? We know that tax revenue is equal to TY, which is the tax rate times the level of income. Now, I'm putting these things in an abbreviated form, a summarized form in front of you now, because the assumption from me is that you know where this information is and you must go and look for it. If you don't recognize what it's saying, you need to go back to that section until you do recognize exactly what this is saying, because that's what's going to be critical for you, all right, is to interpret what these formulas are. So looking at your T, T is equal to, that's your tax revenue, is equal to the tax rate times whatever your equilibrium level of income is. So once you know what your level of income is, you can work out how much money government is going to receive in tax revenue. Where does it affect the economy? It affects the economy through households, through consumption spending by households. That's where we put it. We know that it'll also affect through firms. We get that. It'll also potentially affect in other areas, but we're not going there. In Learning Unit 7, first year economics, all you're going to do is look at the impact of taxes on consumption spending by households. So be careful, because then you start talking in your explanation about how companies have to pay more taxes and therefore what. No, you can't do that, because we've taught you that taxes is only working through consumption. be careful. Then we go to calculating equilibrium level of income. What are we doing here? Well, we need our little multiplier, which we learned in Learning Unit 6. Remember, that's assumed knowledge now. So from Learning Unit 6, we learned what does a multiplier look like, but our multiplier has now changed because what we've got to do is we've got to put in taxes. So notice now it is 1 over 1 minus little c, which is your marginal propensity to consume. Open your brackets, 1 minus little t, which is your tax rate, close your brackets, and then times your autonomous spending. All right, so it's really, really important that from a theoretical perspective, you can explain exactly what is on this slide. If you can, and you've memorized it correctly, you will be able to cope with what the questions ask you in that exam. All right, let's get into the application part and a little bit more theory before I do. Oh no, I'm going straight into application. I'd forgotten I'd put this in to test you already. So what I want you to do now, I'm going to give you a minute. We're at 9:26. We're going to give you till 9:28. And what I'm going to ask you to do is just to see whether you can answer these 3 questions. Once you've got answers for all 3 of them, then you can just pop them into the chat line, and then I'll know that at least some of the students have completed those, and then we can see, are you on the right track or are you not? Remember the value of the multiplier. Your multiplier now is your 1 over 1 minus little c, open brackets, 1 minus little t, which is your tax. So just going back, in case you haven't got your formulas in front of you, just going back. So your formula that you're going to be using is this one here. This is your your equilibrium formula. Your autonomous formula is going to be this one here. So your autonomous spending is going to be that one there. All right, giving you a few moments to do that. Keenan, the multiplier. Okay, so that's exactly, okay, good. That's exactly what I wanted you to realize, is your multiplier is just your 1 over 1 minus c. We'll go on to the slide now that'll show you the answers. But I want you to be careful. Be able to separate the equation, break it up into its parts, because that is one of the problems that we see all the time in that final exam. We ask you just for the multiplier, and you calculate the equilibrium level of income for us, and then you lose your marks because you haven't done what we've asked you. All right. Also notice in this case what the instructions say. So in this case, this was a closed economy. So here there was no X and Z, and we didn't give you that information. But depending upon what they give you, you use all the information that they give you, all right, required for that particular multiplier. So if they give you an open economy, then you've got to do the big multiplier. If they give you only the simple economy, Learning Unit 6, then you do the 1 over 1 minus c. But if they give you government sector, then you must put taxes in. So being able to recognize what is required at each stage is absolutely critical. Let's go and have a look at what you should have been able to do. Here they are. So you should have been able to show us that the multiplier is equal to 2.9. Now, what I want you to do is take a picture. Let's quickly go back. Is make sure you've got this information. Take a screenshot or whatever. And at some point, you don't have to do it now. Make sure you can go and do these calculations, that you recognize what the question is asking, and you can then do it. And then, of course, you've got the answers. So the answers are here for you. Once you can do something like that, then at least you've got the basics. Now, are they going to ask you this question? Well, potentially they could. They have in the past. So they've asked you for a closed economy in the past, but they're much more likely to ask you for an open economy. So that's why I'm going to do now X and Z. We'll put in exports, we'll put in imports, and then we're going to do the final one, which will require you to do the calculations in an open 4-sector economy. All right. But if you're struggling with this one, you're going to struggle even more with the final one. So being able to break it down into all its parts is absolutely critical. I hope that is a little bit of an illustration for you as to why it is necessary for you to be very cautious when you're dealing with these questions. All right, so a quick look at the graph for government and taxes, government spending and taxes. And here comes some short multiple choice questions or true-false questions. You've got to be able to tell us that an increase in government spending will shift the A line, the aggregate spending line. Up if government spending increases, down if government spending decreases. Now that they don't have to ask you in a graph, they can just ask you in simple theory. Government spending shifts the aggregate spending curve. Taxes swivel the aggregate spending curve. Notice the difference between a shift and a swivel. Yes, no, the recording, I'll send the slides through to your campuses, and then obviously some will be distributed. It depends on your lecturers. Sometimes they don't get the message in time, or they don't realize that they can distribute. But if you want them and you've sent a message to your lecturer, then usually they'll distribute them to you, all right? So please, a quick reminder, government spending shifts your curve, taxes swivels your curve. Another factor that you've got to be able to bear in mind, once again, from a theoretical perspective, not necessarily from a graphical perspective, is the difference between equilibrium and full employment. What do we mean by that? Sometimes that's what they ask you, just to describe what is the difference between these two. Full employment, folks, is where we use all our factors of production. So YF is all factors of production are fully utilized. Or land, or labor, or capital, or entrepreneurship. We do not have to be in equilibrium at full employment, and often we're not. We're stuck in equilibrium at a position that is below full employment, and equilibrium is simply where our aggregate spending line intersects with our 45-degree line. So if you had to describe your equilibrium, that's what it is, where aggregate spending intersects with our 45-degree line, which represents A is equal to Y. So making sure that you can describe the differences between those two. Also comprehend, understand what the differences are. Then it becomes easy. You don't even have to learn it because you actually know what the difference is. So be careful of that. And then often what they ask us to do is calculate by how much must A shift upward in order for us to be able to be in equilibrium at full employment. And of course, that is something I'm going to show you in a moment or two. You've got to be able to illustrate that. All right. There we go. So how does the economy get to full employment? What we do is we have to shift that line upward, and that will bring us to equilibrium at full employment level of output. And then they're going to ask you to do the calculations, and there's your formula. Now, it could be a change in G, delta G, or it could be a change in investment, delta I, which we'll use exactly the same formula for it to take us to equilibrium at full employment level of output. At this point, any of you who've thought about it and have been interested in economics during the course of the semester may be thinking, well, if it's that easy, why can't we solve the problem? Because clearly here we are in South Africa, and we are definitely not in equilibrium at full employment level of output. But of course, way more complex in the real world than it is in economic theory. The idea is correct. This is what we want to achieve. The complexities are what we've got to work on to be able to get us to that point. All right. So don't discount the theory completely, because in reality, we are working towards trying to achieve what we're illustrating to you here on the slide. All right. So you're going to have to practice something like this as well in a moment. Let's take a look. We've got to add in X and Z. You've got to get exports and imports into your model so that you can use them in the calculations and you can answer theoretical questions on them. I do assume at this point that everybody knows what exports are and what imports are. But in case you don't, make sure you are comfortable. And remember that when we talk exports or we talk imports, there's two aspects to them. Exports are the actual goods and services that we sell to other countries. But then X can also represent the receipts for exports, which is the money that flows into the economy. So be very careful when you are working with it that you understand what you're doing. So X exports is considered autonomous, and that means it is not dependent on income. Anything that is autonomous in the Keynesian model means that it is not dependent on income. So X is autonomous, but, and here's something that's not on the slides in front of you, you must be able to tell us what are the factors that will impact on export. So let's quickly put those into the chat here. Two things. Check your notes. You may have others, but at least you've got two here. Factors that impact on exports, the exchange rate, and then income of trading partners, or what we often call foreign income. Make sure that you know that. Once again, possible short question. Then we go to Z. Now, Z is a lot more complex for you. Please put a bit of time and effort into understanding it. It's not difficult. It just needs you to think a little bit about it. First thing, though, remember that imports are a leakage. And then it's made up of two parts, autonomous component, which is Z with the line on top, and the induced component, which is your little my. And then your induced component, obviously, we're going to look at in a little bit more detail in a moment, because your little m is your marginal propensity to import and how much of our income do we spend on imports. So that's what it's actually illustrating for you. And then, of course, your net exports. We show it to you often in your C plus I plus G plus X minus Z is net. Your X minus Z is your net exports. It is always net exports, whether imports is greater or exports is greater. And we must therefore be able to identify, is it a trade deficit or a trade surplus? Being able to see whether it's more money coming into the country or more money going out of the country. Let's have a look at what it does to all of our formulas. There you have your imports, because your imports is your more complex one. I've given you a whole slide here for it and shown you how it impacts on some of the formulas that you have now become familiar with. First of all, being able to describe your Z equals Z with the line on top plus MY. I've given you all the information there. And then what would it do to aggregate spending? Noticing that it changes your formula for aggregate spending. Notice there I say aggregate spending, not autonomous spending, all right? And then, of course, very NB for you is it changes your multiplier. Now you have to be able to work with this multiplier. So now you've got 1 over 1 minus C, open brackets, 1 minus T, your tax rate, close brackets, plus little m. Please, students, we see students lose marks every single time in the exam because they forget to put in the little m. So silly. They get their calculations are correct. Their formulas are basically there. They know sort of what they're doing, but they forget to put in the M and the X and the Z, and so they lose their marks. Such a waste. Let's go put you to the test. There is all your equations that, well, not quite all, but quite a few of the equations that are critical for you to be comfortable with and know what they represent. As I say, they will be on the formula sheet, not all of them necessarily. but some of them, so you will have the backup, but you need to be able to interpret them correctly. Let's go and put them into practice. Here we go. So what I'd like you to do is I'd like you just to do the first three, then we'll talk about, when I go to the answer sheet, we'll talk about the last ones. So if you can calculate the value of the multiplier, calculate the value of aggregate autonomous spending, and then what is the equilibrium level of output. Now, these questions that I'm giving you here are all questions that have come from past papers. So that is why I'm kind of anticipating that you might have something similar. Last year, 2024, was a very different format. Same requirements, you were still doing the same kind of calculations, but the way they gave you the information was different. So if any of you have looked at the 2024 paper, that is good for you to see a different way of doing the same story, but then also make sure you can work through some example like this, which would then allow you possibly to be able to deal with whatever they give you in that final exam. All right, we're at 9:40 now. So what I'm going to do is I'm going to give you 2 minutes again. Just the value of your multiplier. You don't need to show me your formulas. I've given you the formulas in front of you there. All I want you to do is see whether you are able to get the correct answers at this point, and being able to apply the formulas correctly. Do your value of your multiplier, your aggregate or autonomous spending, total autonomous spending, and then your equilibrium level of output. All right, giving you 2 minutes. All righty. I don't see any information coming through. I don't see that anybody has replied, but please, once again, there we go. Multiply value. At least we've got one. Autonomous spending. Yeah, absolutely well done. Thank you for that. You've at least managed those two and you're well on your way. And potentially that could already be 6 marks, because sometimes it's 3 marks for the multiplier, 3 marks for the autonomous spending, and then potentially 2 marks for the equilibrium level of income. So you've already collected quite a few marks. Well done. Let's go and have a look at the solutions, and we can talk a little bit about anything that is super important. All right. So here I've done it all for you. I've shown you how to calculate it. So I've put the information in for you. You'll see it there. It's very small on my screen. Hopefully it's a little bit bigger on yours, but at least once you've got the slides, you'll be able to have a look at that. That was your multiplier. So you had to do your 1 over 1 minus 0.6. You got your information from there. Remember, you don't put a y. Nowhere do you see y's in your multiplier. All right. Multiply is just made up of 1 over and then all decimals or fractions that you might have available to you. All right, so please don't start putting Y's or A's or C's or G's or anything else into the multiply. It doesn't happen. So there was your multiply, and that would have given you 1.61. Then your autonomous spending, calculate the value, and don't be confused by this. Was quite a thing that they did in the exam, which I wasn't altogether happy about. But now that they've done it, we've got to get comfortable with it. And that is using the word aggregate together with autonomous, because we don't usually do that. We clearly differentiate between aggregate spending, which is total spending, and total autonomous spending, especially because we know students will get confused, but they did this in the exam. So I want to alert you to the fact of watch out. So aggregate autonomous, we're not interested. That is just another word for total. And autonomous spending is what we're interested in. So that was your C with the line on top, I with your line on top, G with your line on top, X with your line on top, Z with your line on top. All right. Making sure that you get that right. And there I've given you the numbers, all of them, which would have given you 1305. If there are units and millions, then always go back, make sure you put them in at the end. You don't have to put them in all the way through your calculation, but you must put them in at the end of your calculation. And then your equilibrium level of income, folks, you got to know by now that your equilibrium level of income is your multiplier times autonomous spending. Whether you do it in one equation, in total, or whether you do it in step by step, calculate the multiplier and then calculate autonomous spending. Essentially, you get the same answer. There's a slight discrepancy depending upon how you do it on your calculator, but that's what you're doing. So please, if you haven't grasped that yet, start to grasp it now. Equilibrium level of income is equal to my multiplier times whatever my autonomous spending is. That's what your formula tells you. All right, so that will also help you then to double check yourself. Then we go to the last two questions. Calculate the total tax revenue at equilibrium. Now, remember, you've got to now know what your tax revenue formula is, and that is simply your tax rate times the level of income. And then which level of income are you going to use? You're going to use your equilibrium level of income. So we go and collect. We know our tax rate is 0.2. So there we've got it, 0.2 times, and then we go and collect our equilibrium level of income, and we pop it in there, and then we get our answer. So our tax in this economy is 420.21 million. So now we've calculated our tax revenue. And then what we had to do was we had to go and find out how to get to full employment. And so what we did now is we had to work out delta G. Now, remember, you saw the formula for delta G. It is equal to YF, which is full employment of income or production, minus equilibrium, whatever you've calculated, divided by the multiplier. And then you've got your answer. All right. Ladies and gents, critical. Critical that you can do this. This, we saw in the exam brief, that this could be 15 to 20%. So arguably, this could be 15 to 20 marks that they're asking just on Learning Unit 7. All right, maybe with a little bit from Learning Unit 6 incorporated as well. And then they won't only be calculations, they potentially could be theory as well. So just make sure that you are absolutely comfortable with this section because it's going to be critical. All right, we've got to move on. But before we do that, I want to just see, is there anybody, the solution to the last one? So just checking, please repeat the solution for question 5. That is the last one, I'm assuming, which is, let's go 1, 2, 3, 4, 5, which was your delta G. All right, so let's have a look. What we want to know is how much must government spending increase in order to get us to equilibrium at full employment level of output. How do we do that? We use our formula. And our formula is change. Let's just remind you here. Change in, I can't do it in a formula format. I've got to do it in words in the chat, all right? So change in government spending equals YF minus YE divided by multiplier. Let's put brackets around those two so that they don't confuse you. Right, so that was the formula that we showed you earlier. Delta G is equal to YF minus YE, which is full employment level of output or income, which they give us here, full employment. They tell us what it is, 2237, minus your equilibrium, which is what you've calculated, 2101.05, and then you divide that, so whatever your answer is for that change in income, you divide that by your multiplier, which you've already calculated. So all it is remembering actually what to put in that formula, because you've already got all the information. So putting the information correctly into the formula, and the answer that you should get if you do it correctly is that one, 84.44 million. Within reason, there might be a slight difference in your decimal change, but basically that's your answer that you'll be getting. All right. So ladies and gents, I urge you, there are other questions they can ask as well. So, but if you've gone through everything that I've done in these slides, you should be able to deal with any of those alternative questions that they decide to put in if they don't choose the kind of questions that I've given you here. All right. Anybody got anything else they want to ask on Learning Unit 6 or 7 before we go and take a short break? Good question. Good question there. It depends. Do they tell you that it's the simple Keynesian model, which will be Learning Unit 6, in which case you don't put in the tax? Or do they just say Keynesian model with consumption spending with a government sector? So if they say there is a government sector, then we definitely put in the tax. If they just ask us about the simple model, then we don't. If they don't say anything, then just do both. Just show the consumption, just show me that you know consumption function without government is C equals C with a line on top plus little cy, and then you say with a government sector, and then you give me the little c 1 minus t y. All right, so just use a little bit of common sense there if you're not absolutely sure. Often I'm quite lenient with that, especially in the final exam, and I'm sure most of your lecturers will be, especially if you're able to illustrate clearly that you understand there may be a confusion in this question. It wasn't quite clear enough which one should be utilized. All right, let's go and take a break. I will be around if you've got any more questions. I'm going to ask you if you can be back online or back with me on the hour, which will be at 10 o'clock. See you now. Absolutely. Thanks, Joshua. Just a note to students to notice what Joshua has also told us is that the multiplier is important in every respect. Knowing what it looks like, knowing what it does, being able to explain it in terms of a theoretical aspect, and then obviously being able to apply it, which is what we've been doing here. And sometimes what they do is they just ask the question on the multiplier. So they'll put a little sneaky multiple choice question or a true false question. And all that really doing is testing. Do you know how to calculate the multiplier, and do you know the impact that it has? That it will always cause, and if you understand your equation correctly, the multiplier will always cause the impact on income to be greater than any change in expenditure, or even given the expenditure that is existing in the economy. So that is the beauty of our multiplier. And remember, it works both from a positive and a negative aspect. So our multiplier will cause our income to increase by more than, say, a 40 million investment into the economy will increase by more than 40 million. But at the same time, if somebody takes 40 million out of the economy will decrease. The level of output income in the economy will decrease by more than that 40 million that was extracted from the economy. So we tend to focus on the positive effect of the multiplier, but it also can have a very dangerous negative effect on an economy. All right, looking, Swanaka, so there's the formula for the no, you don't want a Z there, you want a little M. Yeah, there you go. Plus no Z. We don't want to see Zs in the multiplier. No Zs, no Cs, no Is, no Gs, no T. Oh, I lie. There's a little T in there. Little T and a little M. All right, so be super careful when you're doing your multiplier. Hopefully that was just a typo and not your knowledge error. Yippee! So glad. No worries, you got that. And obviously it depends on what they're asking you. So the formula in this case has to be as you've represented it because all the information was given to you. They can be tricky and they can sometimes ask you to change or to mess with that multiplier. I think you might have seen that in previous papers where they then say what happens if maybe we reduce taxes to naught or we don't import anything or something along those lines, and they can play around with that. But if you understand your multiplier and you know what it represents, then you're going to be absolutely fine because you'll be able to amend it according to what the question asks. Okie dokes. So everybody, if you're watching, I'm just going back before we get started again, I'm going to go back. So you started showing, you just want to see the first few. All right, I'll zip back quickly for you and then we'll come back here. Hopefully the system doesn't bomb out now, but I don't think it will. Okay, so all you missed really was the introduction. And that was just reminding you what you need to do. So we started off with, just let me see, remind myself. There we go. So we started there. Then we just said to you, what must you do? A few little bewares, make sure that you've covered everything that's required. And then be patient when you're studying. Be patient, but be smart and put yourself under time pressure. Make sure that you work through stuff and then remember what's critical. Your exam brief, which you should all have. If you haven't discovered it yet, it should be in your student material, which does give you an idea which sections are super important. Don't underestimate the ones that have got only a little bit of marks, but what's super important is obviously where they've allocated a lot of marks. And then I gave a suggestion when you're studying each of your learning units, make sure that you detail first what has to be covered. And then you're less likely to leave out stuff because you've got to go through a tick box and say to yourself, yeah, I've covered all of this. Basically, this is like your learning outcomes. So it shows you all that information. And then this little story, just what we're doing today. And then, of course, when you came in, so you were good and picked up the rest of it. All right. All good? Just going to zip forward. Don't know what it does to the recording, but anyway. Alrighty, we're back. Let's go and see what we can do now to help you with these last few learning units, which are super, super important, all of them. And the main reason I say they're super, super important is because remember, you haven't studied them before for a test. So now you've got to make sure that you really know them well, because you're only going to get one chance in the exam now to see whether you've got enough knowledge on them or not. All right. The ADAS model. Also, once again, breaking your learning unit down into its different components. You've got the ADAS model, which is really just introducing you to this model and then expecting you to learn all the detail about it. And then you have a look at monetary and fiscal policy using the ADAS model, super important, both from explaining and from illustrating perspective. You have your lags, which is the delays that we experience when dealing with policy actions. We have the supply side. We teach you from the demand side. So all of the economics we really teach you is from the demand side of the economy. And then we introduce you very briefly to one little bit of information on supply side, but they love asking that, so watch out for it. And then the big one in this learning unit, which often causes a lot of trouble for students, is your transmission mechanism. And of course, we're going to look at that. That comes in the middle somewhere, but it's a big one that students need to pay attention to, particularly if they do ask a long question on it. All right. Let's go and have a look at what all of this covers. Here's your first bit of example again on the types of questions for the ADAS model. You'll notice I've chosen mostly longer questions here because often we do have longer questions coming out from this section. I noticed the mark allocation has changed a little bit, so there's way more questions coming from Learning Unit 9 than from Learning Unit 8. But let's not underestimate the ADAS model in any case, because it is sometimes critical for what you're going to understand in Learning Unit 9 in any case, and then also in some of your later learning units. All right. So make sure you can answer all of these questions before you go into the exam, because then that would equip you quite well for being able to deal with any question that they might ask you. All right. We'll obviously be answering these mostly as we go through the information. First step, do you know what AD is? Do you know what AS is? We kind of assume that students get this fairly easily, but then I often notice that I'll ask a student about the aggregate demand curve and they don't necessarily know what I'm talking about. So please, do you know what we mean by AD? And also, you can't just talk about demand. At this stage, we have to penalize you. If you talk about just demand, you are wrong. You've got to make sure you're talking about aggregate demand, all right? Because otherwise, you're reverting to microeconomics and you're not focusing on macroeconomics. Do you remember what determines the slope of the AD curve? Remember, there's three determinants of it. Make sure you go and have a look what those are. I'm not going to give them to you now. These are things I want you to be able to do. It's critical information. And often if we just give it to you, you don't remember it. Whereas if you go and have a look and remind yourself, you're going to be able to tell us, okay, we know what are the three things that give us that downward slope. Remember, it's an inverse relationship between your price level, which is your vertical axis for your AD model. We're going to look at that in a moment. And of course, your horizontal axis, which is your level of income production in your economy. All right. So remember, you've got to tell us what is it that causes that downward sloping AD curve. Then what is absolutely critical, basic knowledge that you've got to know. You cannot go into the exam without knowing it. And that is what are the factors or the determinants that shift the AD curve. And you must know which way they're going to shift it. Are they going to shift it to the left or are they going to shift it to the right? And then the same goes for the AS curve. You need to know everything about the AS curve. The difference here is that we have a positive relationship. There's a positive relationship between price level and the level of output. And then what we do very briefly introduce you to is the difference between the short run aggregate supply curve and the long run aggregate supply curve. We introduce you to it here and then we don't really use it much during the rest of the syllabus, but you do need to be aware of it. So please watch out, make sure whatever your lecturers have told you, you go in and see what is the difference between the two of them and what accounts for that difference. And then, of course, basic information. What are the factors or the determinants that shift the AS curve? All right, so all of this is critical information, ladies and gents. If you can answer all these questions, then you've got a good start to understanding your ADAS model. Then we go in and we're going to put you to the test a little bit. So I don't know, I haven't seen much response from you, but I'm going to give you a chance anyway, just to see if some of the students would like to respond. And now we're going to ask you a few questions. The first thing I ask you, and I did just tell you, but let's see if you remember, what label do I put on my vertical axis for my ADAS model? What label goes on my vertical axis? Ah, well done, Anati. You went straight in, absolutely correct. And I wanted to check that you were going to put in price level and not price. Well done. Always got to be price level. If you put in price there, we're going to penalize you, all right? Because it's not price. Price is microeconomics, it's price level. So please make sure that you do. If you use P, then when you are indicating equilibrium, that's absolutely fine. I personally prefer students to use PL, which indicates price level, but that will depend on what you've been taught, and also the textbook uses P, so we can't penalize you on that. But you can't put just a P at the top there, because then you are wrong. All right. And then, of course, the label that we must put on this axis here, can someone tell me? What are we going to put here? There we go. Thank you, Maria. Absolutely. We're going to put Y, total production income. Absolutely. So now we've got our axes sorted. And then remember your AD curve. A lot of people I noticed are still confusing their aggregate demand and aggregate supply curves when they're drawing their graphs, when I made them practice some of these. So please be super careful. I think it's a careless mistake. It's not a lack of knowledge. It's just you don't focus when you're labeling it. So just make sure that you are absolutely clear. The downward sloping is your AD. So here we have our AD. Often this is a bit difficult for me to do there, but there's my AD. And then, of course, I've also got here my AS. So looking at our two curves, making sure that we know what they represent. So there's our AD, our AS. And then please, folks, also something I notice that students are often not doing is they're not marking their stuff on their axes. So what you want to do is, if you're going to do this graph, you need to make sure that you've put in. So if I was doing it, I would go in here and I'd put PL, and then here I'm going to put my Y. Be careful, watch out you don't do a Q here when you are doing it. Make sure that you are putting in your Y for the level of output or production and income. And then obviously you can also try and remember to mark your equilibrium position there. So showing all that information in any of your graphs that you're working with, all right? So now what I want us to do is I want us just to go and have a look at each of these determinants that I've given you, a little scenario, and then I want you to tell me in the chat line which curve is affected and which way it's going to shift. So you can just say, for example, AD right or AS left, whatever one you think it is that is going to be impacted, all right? So we're going to go first, a decrease in the investor confidence in the country. So if there's a decrease in investor confidence in the country, what do you think is going to shift and which way? Giving you a moment or two to see if anybody's going to answer. And if you honestly don't know, then just putting in question marks for me is also a good thing, so that I can actually see what's happening. Ah, okay, so that's what I wanted to be able to see. So students, this is how we learn, all right? We make mistakes and then we fix them. So the first one, Baptista, you are absolutely correct. AD will shift left. For those of you, and that's what I wanted to show you here, be careful, because we automatically, when we see investment, we want to go for AS, because in our mind, that is going to impact on supply. But remember that a core component of aggregate demand is investment. Aggregate demand is made up of C plus I plus G plus X minus Z. So an NB for yourselves. Put a big NB somewhere on your pieces of paper that you will notice and remember. Investment in the ADAS model is going to impact on aggregate demand. All right. So your left were correct. You wanted to decrease it, but you needed to make sure that it was aggregate demand that was decreasing and not aggregate supply. All right. So hopefully we've all realized something there. Then we go to the second point. So you can do it again here for me now. A decrease in global trade because of the pandemic. So decrease in global trade because of the pandemic. Baptista, we caught you here. Sorry. But once again, remember, global trade is going to be X and Z, and X and Z is incorporated in aggregate demand. All right, Mohammed as well. Do you see how easy it is to go in the wrong direction? But I promise you, if you've learned all the factors that affect demand, aggregate demand, and you've learned all the factors that affect aggregate supply, you'll be absolutely comfortable. You'll work it out. Your brain will help you to do that. All right. So just a super cautious, be very, very careful there. Then we go to a decrease in the cost of imported intermediate goods. Not sure if that's where you've gone, Baptiste, which one you look, that was you're still looking at the second one. So now we're looking at the third one. There we go. Now you're correct. That's AS. So be careful. Be careful. As soon as we start talking about the costs of imported intermediate goods, that assumes that it's going into or implies that it's going into production, and anything that goes into production is going to affect AS. Absolutely correct. It'll be AS curve shifting to the right. The cost of production of goods in our country is going to decrease, and therefore AS will increase, aggregate supply will increase, and it will shift to the right. Absolutely. I'm happy about that one. And now we've got the last two, which are NB, 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 folks, and that is anything to do with policy and the ADAS model. All right. An increase in the interest rate, contractionary monetary policy. An increase in the interest rate, contractionary monetary policy. Which curve, which way? We can see confusion again. And this is what is so important for you to learn from this, so that you can correct this and now sort it out for the exam. All right. Both fiscal and monetary policy will only ever affect the aggregate demand curve for a shift. All right, there's a movement along the AS curve, but it's not going to shift the AS curve. All right. So fiscal and monetary policy affect AD. In the case of contractionary monetary policy, that AD curve must shift left because the interest rate has gone up. That means we will spend less. Essentially, whichever way we look at it, when we look at the transmission mechanism, it doesn't matter. AD is going to shift to the left. All right. So AD left, correct, those of you who said that. And then looking at the last one, expansionary fiscal policy. AD right. All right. So just be clear for yourselves. Contractionary, fiscal, and monetary policy will always shift AD to the left. Expansionary monetary and or fiscal policy will always shift AD to the right. Ladies and gents, I hope you've learned something there that will stand you in good stead for the exam, and you'll be able to deal with it well when you get to it. All right. So well done. All right, we've had our break, so I'm going to zip over this little one. And then we get to our transmission mechanism. So your transmission mechanism, I said, is the big one, which is quite a difficult section for most first-year students to learn. But keep it simple and keep it accurate. So know, first of all, what do we mean by the transmission mechanism? Be able to define it. And it is in simple terms, in other words, not the definition, but to help you understand. It is simply how the message gets from the financial sector. So when SARB messes with the interest rates or the banks change interest rates, how does that message get into the economy? In other words, how does it affect you and me? Well, it comes in through 4 different channels. There are 4 ways. If you're wondering about what do we mean by channels, well, if I said to you, how can you communicate with your friends? I'd say, give me the channels that you can use to communicate with your friends. You might say to me, well, I can use WhatsApp, I can use SMSs, I can make a phone call, I can send an email. Absolutely, you've got all of those different channels. Those are channels of communication. But we're now asking you, what are the channels through which the message from the financial sector comes through to the real economy? And we've taught you 4 different ways. You've got to know all 4 briefly, and then one of them you must know in detail. And the one that you need to know in detail, because that's the one we focus on, is the main channel, is the effect of the interest rate on investment. And that is what we show you. We show you graphically, we ask you to explain it, and then we also show you the economics shorthand. I call this economics shorthand because what it does is it helps us to give a big story in one line. So what it's doing here is it's saying if interest rates change, this should be a little I. So just if it doesn't look clear on your screen, this is a small I. If interest rates change in the economy, that will have an impact on investment in the economy, which will impact on aggregate spending, because we know that one of the components of aggregate spending is investment spending, and that in turn will affect the level of output. That's our Keynesian model. If we are looking at it in the ADAS model, then we need to be able to show that a change in investment will lead to a change in, a change in the interest rate, will lead to a change in investment, which will lead to a change in aggregate spending, same as the Keynesian, but then it changes, which in turn will cause aggregate demand to change, which we now know from our model will have an impact on the level of output. And what you can't see here possibly is the price level. All right, so it's been able to do that shorthand to help you be able to remember what the story is. If that doesn't work for you, then of course you've got the graphs, and the graphs you've got to be able to do. Now, do they ask all 3 in the final exam? Well, they can, but they don't usually. What they usually do is they usually ask us 2 of them. So it'll be usually this first one, the interest rate, the impact of interest rate changes on investment, and then they either expect us to go through the Keynesian model or they expect us to go through the ADAS model. Now, the reason I haven't labeled these 2 bottom ones here, folks, is I want you to know when you look at this slide, you must recognize automatically what you're looking at. If you don't know your work well enough. All right, I'm not saying you must be able to give me a full essay on each of these, but when you look at this, you must know straight away, this is the Keynesian model. Yes, I got that. I recognize it. This is the ADAS model. Yes, I got that. I recognize it. All right. If you can't, you haven't studied enough. You got lots more work to do. All right, but I'm assuming that most of you can. Certainly most of you that are here with me now. How do we actually put the transmission mechanism into action? So this is your starting point. At this point, we can't necessarily see the transmission mechanism working. Now we want to go and put it into action. Let me show you what the finished product would look like once we've put it into action. There we go. So let's assume the interest rate went down. So SARB announces for us expansionary monetary policy. The repo rate goes down, and we all know if the repo rate, which is the rate at which the central bank lends to the commercial banks, if the repo rate goes down, we know that all other interest rates will also go down. So we can safely assume interest rates in the economy have gone down, and that will have a positive impact on the level of investment. Investment spending in the country will increase. We show that on our investment graph. Then we go to our Keynesian model, and we should know that an increase in investment, which is autonomous for our purposes, will cause that aggregate spending line to shift upwards. And as a result, the level of equilibrium level of income will increase. There's our explanation for the Keynesian model. Then we go through to our ADAS model. We have learned in Learning Unit 8 that investment is an important component of aggregate demand. Therefore, if investment increases, aggregate demand will shift to the right. And as a result of that, our price level will go up and the level of income or production will also increase. There's your explanation for your ADAS model. All right, so just making sure that you're really comfortable with that. And honestly, by learning and understanding this, it actually helps you with quite a lot of other stuff that you've got to know as well. It's worth putting in the time and effort. All right. Moving now on to the next section here, and that is your lags. When we are dealing with fiscal and monetary policy, remember they are demand management policies. Why? Because they impact on aggregate demand. So hopefully you're getting an aha moment here when you remind yourself that they both affect aggregate demand. Whenever we're dealing with the policy actions, there is a time delay. And that's what we mean by lag. It is simply a time delay, but we've divided them into different groups. So we say, first of all, there's recognition. Do we recognize that there's a problem? Then we've got to make a decision. Are we going to use monetary policy or are we going to use fiscal policy? And which one will be quicker? Then we have the implementation lag. Will we decide now what we're going to do, but now it takes time to make it happen? And then your impact lag, well, now we did what we thought was the best. What is the impact? Can we measure what the effect was on the economy? Make sure you can describe each one briefly. And then very important, do you know the difference in timing between the different policies? So here I've given you just a brief note. This is very clearly explained in the textbook, and table 19-3 gives you the information that you need. So an NB there, just to be comfortable with this, and then be able to answer any questions that they ask you on it. And then, as I said to you, the very last part of this chapter is the supply side economics, which is sneaky because we tend to forget to learn it. And then they ask us for 5 marks, describe what we mean by supply side economics. Be careful. All right, what's on the slide or whatever your lecturers have given you is going to be what's adequate, but pretty much this is what you've got to know. Supply siders generally want government to butt out. They don't want them to interfere in the economy. They're always arguing government spending is too high, taxes are too high, and there's too much regulation. So they will call for deregulation, which is taking away rules and regulations from various sectors in the economy. They will shout that government must spend less, and they will also say you must tax us less. So simple. Don't overcomplicate it. Keep it simple. That's what you need to know about the supply siders. And that pretty much takes us to the end of Learning Unit 8, which brings us to, we're lumping together 9, 10, and 11, mostly from a time perspective. Don't see that as a significance perspective because these 3 learning units are super important. Each of them is going to have a question in their final exam. And some of them may have more than one question, all right? So they are super important, but I put them together now because obviously we've got to get through these last few ones, and I want to show you what's super important in each case. Some of the questions you should watch out for: explain why demand management policies are not suitable for solving the problem of stagflation. We'll get to that and look at it in detail. Explain with the aid of a graph the trade-off principle between inflation and unemployment. That's your Phillips curve. Make sure you know it. List 3 factors that contribute to cost push inflation. We're going to have a brief look at that. Describe 2 supply side policies that could be used to reduce unemployment. Remember, for unemployment, you've got demand side policies and supply side policies. Discuss the consequences or the costs of unemployment. A lot of marks there, be careful. And then we say members of Gauteng's government up for re-election are claiming that unemployment rate is not accurate because discouraged workers are not considered. Give a brief explanation of the difference between the narrow and the expanded unemployment rate. Your narrow, another word for strict, all right? So strict expanded unemployment rate. And then describe how economic growth is measured and what the problems are when dealing with gross domestic product as a measure. Some important questions, ladies and gents, that you've got to be able to answer when you're going into this exam, all right? Let's start with our inflation. We already broke our inflation down into the key components. You saw that right at the beginning, and that is still as critical now as it was when I started off today, all right? So making sure that you can define inflation, you can describe the elements. Here you have definition. What is critical in your definition? Continuous considerable general or continuous significant general, depending upon how you've learned it. Continuous, we can also use ongoing. So while definitions should be pretty spot on in terms of terminology, there are 2 ways in defining inflation. So we could say ongoing significant increase in prices in general, or continuous considerable increase in the general prices in the economy or general price level in the economy. So there is a little bit of variation that we are able to accept in our definition, but when you're looking at the elements, you want to talk continuous, which is it can't be a one-off, it must be ongoing. Considerable, it has to be above a certain level, otherwise it's not necessarily considered significant enough to be inflation. And general, it's got to affect all prices or most prices in the economy, all right? Then we go on to measuring inflation. Please know your 4 tools or methods for measuring inflation. You must be able to name them, describe them, differentiate between them if required. Could be any number of questions they could ask you there, all right? I start off by reminding you to be able to differentiate between CPI and PPI because those are very similar but quite different. So students must be comfortable. Remember, your CPI is your consumer price index. Your PPI is your producer price index. Your CPI, cost of production, consumer price index measures your cost of living. So you must be able to tell us cost of living there, and then PPI, cost of production. Key difference, basic difference, but then you've also got the table in the textbook, which gives you the other differences. NB, make sure you know that. Simple, easy question they could ask you, which you can answer, get full marks if you've learned it, and you're going to get maybe 2 marks if you haven't learned it. All right, so please watch out for that one. And then calculate the inflation rate. Now, there's 2 ways we can expect you to calculate the inflation rate, 2 main ways that are tested. We can give you this information. You'll notice here we've given you GDP at current prices, we've given you GDP at constant prices, and we've given you CPI index, the consumer price index. So now there are 2 ways you can calculate the inflation rate. The simple way is just to use the CPI, in which case you do new minus old divide by old times by 100, and that would give you the inflation rate according to the CPI. The second way you could be expected to calculate the inflation rate is using the GDP deflator. So using the GDP deflator, you have a 2-step calculation. First, you've got to calculate your indexes or indices for 2010 and for 2011, and then you calculate your inflation rate. Let's have a look at what I've done on the next slide for you. All right, we've done that one using the CPI. That's a simple, straightforward rate calculation. Everyone should be able to do that. If you're still struggling with that, not sure what to say, you should get it right, because you're probably going to get at least one of those in the exam. So make sure you're comfortable with it. If we were using the GDP deflator, I understand if you're struggling with this, because this is the first time you will have come across it, would have been in this learning unit. You should have practiced it a few times. If you haven't, make sure you do. All right. First we calculate the index, and we do that by saying nominal GDP divided by real GDP. Now that requires you also to remember that GDP at current prices is nominal and GDP at constant prices is real. That is information from Learning Unit 5, students, which you had to study for Test 2, all right? So that's your first step, nominal divided by real times by 100, and that will give you an index number. So now you've calculated your GDP deflator index, and you have to do that for 2 years because you have to have 2 in order to be able to do your rate calculation. We've got it for 2010, we've done it for 2011, and that then allows us to calculate our inflation rate, which will just simply be new minus old divided by old times by 100. All right, so we'll do 111.31 minus 104.49, and then we divide by 104.49 times by 100, and that is going to give you your inflation rate. All right. So folks, just be careful there, cautious. What are they asking you? Is it just CPI calculation, or is it the 2-step calculation? Your effects of inflation, remember your 3 main groups that they fit into: distribution effect, social and political effect, economic effect, and then be able to describe each of them for maybe 3 or 4 marks, maybe potentially even 5 marks sometimes. So just make sure you've got enough information on each of these. Now, this is when I say to you, studying smart. This is your first step. So you make sure, first of all, you know those 3, and then what you do is you go in and you say, okay, Could I talk about distribution effects? Do I understand it? Do I know everything that appears in front of me here? And then we do the same for economic effects. Could I talk about it? Do I correctly understand what appears there? And then we go to our social and political effects. And then notice that this little one pops up as well. Expected inflation. Now, the reason I always leave that as last and with a question mark is that expected inflation is tricky. It can be a cause of inflation and it can also be a consequence or an effect of inflation. Because if you and me expect inflation to be high, we are going to rush out and buy stuff because we're not going to wait because our money, the purchasing power of our money is decreasing. So we're going to rush out and buy stuff. And of course, if we all rush out and buy stuff, we're going to cause inflation because that is going to cause demand pull inflation. So we are then both looking at a cause and effect. So just be careful with this one. When you study it, make sure that you can deal with it accurately if you're going to use it in an answer in your exam. All right. Looking then at causes of inflation, super important, demand pull, cost push. And remember, I said to you, you must be able to illustrate it, you must be able to explain it, you must be able to tell us what causes it, and you must be able to tell us how to fight it. And that won't take you long. Honestly, if you just put your mind into gear and you go through it and just study it very strictly, stick to the key elements, you'll easily be able to do that. All right. Notice that in the textbook, there are other causes of inflation, but the outcomes prescribe only demand pull and cost push. And then be able to tell us what causes it. So, for example, what would cause demand pull inflation? Well, actually, anything that causes aggregate demand to increase, arguably. But what are those things? An increase in government spending, an increase in investment spending, all good things. We need these things to happen in the economy, but we must understand that when they do happen, they potentially cause inflation. An increase in exports, and then a decrease in taxes. So all those things that we think are great, which they are in the economy, may give rise to inflation. Now, why do I say may? Because it's ceteris paribus, assuming that aggregate supply remains the same. If aggregate supply increases in proportion to aggregate demand, then obviously we can keep inflation under control. But if it doesn't, and mostly it doesn't, it is going to give rise to inflation. All right. So making sure that you know these are all things that would cause the AD curve to shift to the right. And that is what will give rise to demand pull inflation. Then we go to cost push. This one is always the more challenging one for students. Right from the beginning in microeconomics, supply was more challenging to most students than demand. Now, aggregate supply is more challenging than aggregate demand. That means you've got to spend a little bit more time learning it so that you don't make silly mistakes. And this will be anything that causes an increase in the cost of production or causes a decrease in aggregate supply. So anything that causes the cost of production to increase will cause aggregate supply to shift to the left. And anything that causes, it might be something like a decrease in productivity, which is going to cause a decrease in aggregate supply. So bottom line, anything that shifts AS to the left, which is a decrease in aggregate supply, will give rise to cost push inflation. Learn them. What I've given you here are just examples. There's a whole bunch of others. And if you've learned Learning Unit 8 correctly, because they give you all the factors that will cause changes or shifts in AD and AS, you will be able to deal with this quite easily. And then, of course, we must go into our graphs. Students don't underestimate the value of these graphs, both in helping you remember correctly. It helps you with the ADAS model, and it also helps you get clarity on demand pull. Notice with demand pull, it is the AD curve that shifts right. With cost push, it is the AS curve that shifts left. And then making sure you can read your graphs. If you can read those graphs, you've got this, folks. If you can't, if you're sitting looking at these graphs and thinking, I don't know what's going on here, you're in trouble. Make sure you sort that out before the exam. This is easy stuff. You get a 10-mark question on this, it's easy. It is one of the easiest questions you can answer if you've studied it correctly. All right. Kayla, yes. Good question. Well done, Kayla. Yes, they are. So if we are looking at wanting to increase our profit margins as businesses, or we are looking at profit expectations, they would both impact on aggregate supply. Absolutely correct. Good question. Thanks for putting your hand up there and drawing my attention to it. All right, moving on to combating inflation. How are you going to fight inflation? Well, it depends. It depends. Are you looking at demand pull inflation, or are you looking at cost push inflation? The ways to fight it are different. Make sure you got that, folks, because that's a theory question. That's not even a graph question. It's simple theory. How do we fight inflation? Well, you'd have to say it depends. Are we looking at demand pull inflation, or are we looking at cost push inflation? Demand pull, we can use restrictive or contractionary, fiscal and or monetary policy, anything that decreases aggregate demand. Because if we just quickly go back to our graphs here that we had a moment ago, if we can force aggregate demand down, then we can bring down the price level. But there's a downside to that, because remember, if we are decreasing aggregate demand, then we are also decreasing the level of income and production in the economy. So going back to demand pull, absolutely, if we use restrictive fiscal and or monetary policy, we can help to fight. We may not succeed, but we can help to fight a demand pull inflation. Ma'am, do we focus on structuralist approach to inflation? Nope. Nope, nope, nope. Only demand pull and cost push. All right. According to our learning outcomes. All right. So stick with your learning outcomes. We don't have to worry about the other ones. All right, going in now to fiscal monetary, just a little bit of advice to you. What is restrictive or contractionary fiscal policy? Government spending decreases and or taxes increase, and monetary policy, interest rate increases and money supply decreases. All right. So just watching out that you actually understand what is expansionary policy, what is contractionary policy. And then cost push, remember, we cannot use fiscal and monetary policy. This form of inflation is very difficult to control. And then I give you some of the information that is relevant. We cannot use fiscal or monetary policy. We can use incomes policy. Make sure you know what that means. That's basically some form of control of prices and or wages and salaries in the economy. And then we can try and increase the productivity of workers. But it's really hard. It's not something we can take, policymakers can take a decision and know that they can implement. These are things which are difficult to force on an economy. All right. So there you have basic information that is absolutely critical for your final exam. Another bit of critical information, your Phillips curve. Can you use your Phillips curve to illustrate the trade-off principle? And can you use it to illustrate stagflation? Make sure you recognize the difference. Here is your trade-off principle, which is your inverse relationship between the inflation rate and the unemployment rate, moving along the curve. And here is your stagflation, which is a shifting of the Phillips curve. Folks, you've been doing economics for the whole year. What is the one thing that we consistently do? We differentiate between a movement along and a shifting of. Over and over and over again. All right. So by now you should be saying, oh, I got this. I can see. Okay, I got what the differences are. Obviously, knowing what is on your axes is absolutely critical. Make sure you've got that sorted. You've got lots of different graphs to learn for this final exam, and almost every single one has got different labels on the axes. Cannot stress that enough. Pay attention to what you're doing. When you draw your graphs, first thing you do, label the axes, and then go in and tell us the story. And then also remember, don't get confused here. That P is not for price. That P is for Phillips. NB students often forget that. And then in their story, they're talking price, 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 price. And I'm thinking, what is going on here? You've understood this correctly. You've got your right axes. You've got your downward sloping curve, but you're talking about price and not Phillips, your Phillips curve. All right. So please be careful with your explanations. And then know what your stagflation. Your stagflation is showing both of these are moving in the same direction, increasing. So when we've got them decreasing, then it's not stagflation, then we're fighting stagflation. But when they are both increasing, then what we are doing is we are seeing that both inflation rate and unemployment rate are both increasing at the same time, which is not good news for an economy. We do not want to be in that position, and it's a very difficult position to solve. So there's your Phillips curve, and then your very final NB for this one. Ah, okay. A nice one, Joshua, there looking at the difference here. I don't know what you do, Josh, but I'm not super strict with the Phillips curve trade-off. So I often say to them, I'm not going to penalize them if they put the curve inside or if they go through. But I like your comment here that with our stagflation, we're not going through the x-axis. We're putting it above. So I'm not sure what you've done with yours, your students, but I'm a little bit lenient with that. But once again, it does depend on how they've been taught it. So if you're strict on it, then I absolutely get where you're coming from. Yeah. Absolutely. I used to be super strict on it. And then I kind of felt that for first years, it was only once we were looking at it at a second year level and we were teaching the modern Phillips curve that I suddenly thought, actually, you know what, at first year level, I'm not going to get so strict with them. But at second year level, super strict because now we've got to know what we're actually doing. But once again, we're entitled to differ on that. So no worries there. Inflation targeting. And oh, by the way, before I go on, thank you, Joshua, for joining us. Students, Joshua is one of our other lecturers. For those of you who don't know who he is, he's one of our lecturers on the MSA campus. And welcome. And thank you so much for being here. I always like it when there's somebody else that's on board. And then also, please, as you have been doing, throw in anything that you feel is significant for the students. Your inflation targeting, folks, well, sorry for you, but there's only one way you're going to know this, and that is you've learned it. All right. If you haven't learned it, you're not going to know it. If you've learned it, you'll know it. It's one of those things that doesn't require a large amount of understanding. We did introduce it to you in Learning Unit 2. We said to you that monetary policy operates in an inflation targeting framework, and now you need to be able to answer questions on it. All right. So super straightforward, nothing complicated, but you must learn it. Here, I've given you a little bit of a story on what it means. And then what I've done is I've said, NB, just know your 5 essential features. And they're kind of so clear and so easy if you understand monetary policy, because it is, in fact, what our guys do. We can tick off all of these features because our monetary policy does actually follow all of these requirements. And I think that's the end of Learning Unit 9. So NB for that learning unit, everything there is important, all right, because based on the mark allocation that they've given us for that one, I'm reckoning they're going to test us on all aspects of it. So best you know it really well. Your unemployment, also quite a high, relatively speaking, a high percentage of marks allocated to it, given that it's a very small, short, brief chapter. But it means it's all probably important. Your first step is what are you assessing? Remember now, when we look at unemployment, unemployment is not a macroeconomic objective. It's a way of measuring one of our macroeconomic objectives. And of course, that is assessing full employment. So remember to differentiate between your macroeconomic objective and your tool or your way of measuring that objective. Obviously, all the things that you learned in Learning Unit 5 in relation to assessing full employment, and that is we can measure employment and unemployment. We obviously focus on the unemployment aspect of it. Do you know what EAP stands for? Economically active population. Could you describe what that means for maybe 2 marks? And then the formula for the unemployment rate. Remember, this is the one time where we don't use new minus old divide by old. We just use the number of unemployed divided by the economically active population, which is also the same as labor force. Sometimes incorrectly, they do say workforce, but usually labor force EAP is the correct terminology there. Either one we can. There is a slight difference, and once again, we learn that at a second year level, but for first year level, we assume them to be the same. And here is your strict versus your narrow, or your strict versus your expanded, or your narrow versus your expanded. So making sure, folks, that you got this. Easy question, but if you haven't recognized what the difference is between your narrow definition and your expanded definition, then it could get you into a little bit of trouble. Do you need to learn them off by heart? I would suggest that you are very comfortable with giving both of these definitions. And make sure that depending upon the mark allocation, you would be able to give us enough information on the strict and then also on the expanded. What else have I got here? Just a reminder that EAP, how to describe EAP, what it consists of, and then also that it is the same as your labor force. Your different types of unemployment. Now, I don't know, but voluntary and involuntary for me isn't one of the key differences, because all unemployment is either voluntary or involuntary. What is important for me are these four here. Your frictional, your seasonal, your cyclical, your structural. You must be able to recognize what they are, and you must be able to describe them. All right. So I've given a little examples here. Let's just have a look at them. For example, Jack Peterson recently relocated from Port Elizabeth to Cape Town and is looking for a job. There we would say that is frictional. So make sure you could recognize that. Then Samuel lost his job when his employer had to close down the factory because of increased imports from China. You should recognize that that is structural. Then we've got Susan and Karabo were retrenched during the recent recession. You should recognize that cyclical or cyclical. And then casual workers no longer have jobs in January would be seasonal. It's a case of just being able to give an example, if necessary, of each of these different types, recognize them, and then be able to describe them if necessary. All right. Super easy, but you've got to have, this is where I say memorization is important, because when you look at this and you understand it, you think, oh, this is easy, I got this, I'll be okay. And then suddenly when you sit in the exam, you find you can't remember them. Your policies to combat unemployment. Watch out here as well. If we ask you for supply side and you give us demand side, we can't give you the marks. If we say demand side and you give us supply side, same applies. We can't give you those marks. So be super careful when you're studying it. What is it? Is it a supply side policy or is it a demand side policy? Once you've identified that, then it becomes kind of obvious to you. And then I've put into a little box here other strategies, because these could arguably be from either side. So these might require a little bit more discussion if you are asked about them, or use them if it's general. So if we just said to you, discuss policies that can be used to combat unemployment, now you're free to choose from any of those categories. All right. So that is what often, as I say, catches students in that final exam. They know the work, but then they give it to us in the wrong context, because the question has specifically asked for demand or supply, or maybe even other types of strategies. Your very last learning unit, I think we're going to finish it. We'll continue until we do, and then we'll take a break. And then you can decide whether you're here for learning unit 1 through to 5, or whether you've done enough for today. Economic growth and the business cycle. Once again, very short chapter, but super important. All right. Looking at economic growth, you must be able to tell us what is economic growth. You must be able to differentiate between real GDP and real GDP per capita. And then, of course, between real GDP and nominal GDP, which we learned in Learning Unit 5. So making sure that you've got all of these different, you can't just see GDP. You've got to see whatever that word is, that adjective that is describing a GDP. Then your problems when measuring they love this question. They love this question. And then invariably students can't remember it. So please watch out for that one. Your sources of economic growth, super easy in my opinion. But once again, demand side or supply side, what are we talking about? And then your business cycle. Let's have a look at some of this information. Your business cycle, looking at your upswings and your downswings in your economy. They have asked before that students draw the business cycle and label it accurately. So please do be comfortable with that. And then what is super important here, folks, is your use of policy to mitigate the circumstances that are happening in a downswing or in an upswing, all right, or the situation that is happening. So you now have to be able to apply your monetary and fiscal policy in the context of this. In addition, please make sure you can tell us what happens during a downswing. What do you expect is happening in an economy? For example, confidence is declining. People are spending less. Level of output is decreasing. Aggregate demand is going down. Be able to tell us that unemployment is going up. Make sure you've got the correct information for a downswing. What is the correct information for an upswing? Well, usually there's loads of confidence. People are investing in the economy. People are spending. And one of the things that kicks in often in an upswing is the economy overheats. We say that it is growing too fast, and that usually implies that we're going to see inflation kicking in. So now we've got to take policy action to combat that inflation. All right. So for me, this little business cycle story here, right at the end, draws on everything you've learned through the semester. And it really requires you now to truly understand what is happening in an economy and then being able to use your policy to decide what to do. And we assume you've got it. But if, in case you haven't, we go in and we say to you, if we were in a downswing or a recession, what sort of policy would be used? And I give you a brief explanation. Expansionary fiscal policy, and or we don't have to use both. We can use one or the other. Expansionary monetary policy, but then make sure you know what you're talking about. Now, this comes from Learning Unit 3 and Learning Unit 2. Once again, pulling through information that you've already studied. Do you understand it well enough to actually see how it works in the economy? I would go so far as to say, even for those of you who are not going to study economics further, which is the majority of you actually, this is critical information because you're going to need it in your business studies, because they often talk about the policy issues that may be applicable when you're making strategic corporate decisions. And what do you anticipate is going to happen in the economy? There's your business cycle. So this information will continue to be important for you right the way through your studies, and in fact in your life forever, because you are a member of the economy, all right? Jordan, you said very clearly, Tammy Pike, how do we manage our time accurately during our exams so that we can maximize our marks? Good question, Jordan. My advice to you is you do your when you've got 2 hours, which is actually enough time. But what I would suggest you do is, if you're comfortable with your multiple choice questions first, just put a time limit on your multiple choice and your true false, because I think the format of the paper will probably be similar to the tests. Multiple choice questions, true false questions. They don't usually put the match the columns into the final exam. It can, but then don't usually. So put a time limit on those. And I would suggest that you don't take more than a maximum of half an hour to do those. That leaves you a good hour and a half for your longer questions, because that is where you're going to need. You can always go back to your MCQs and your true falses once you've finished and then double check them. But that's where you want to put your time limit on. All right. If you're going to work in reverse, so you're going to do your long questions first, then make sure you've got at least a half an hour left to be able to go on to your MCQs. The danger with the MCQs when you start with them is, if you're not super comfortable, they can end up taking a lot of time, and then you shortchange yourself where you could have got marks in the longer questions. All right. If anybody else has got any other suggestions, Josh, if you've got anything also, please, you're welcome to add. But that is generally what I find is most effective in answering your questions. So just back to your business cycle. I've done your downswings, upswings, your downswings, what kind of policy would we follow? And then in your upswing, this is your problem one, because often you don't think, why would we need to put in restrictive or contractionary policy? What on earth? Why do we want to slow our economy down? But of course, if inflation is kicking in, we don't have a choice. We might have to. Or what you learned about in Learning Unit 3, if the government is facing a massive budget deficit, they may have no choice but to implement restrictive policy. So that can also be necessary. It won't link directly into your business cycles, but may be necessary. And so then we would have to focus on monetary policy, arguably in terms of fighting it, and maybe also implement a restrictive fiscal policy because we've got a budget deficit. So depending upon what the question is asking you, you may be required to use either or in this case. And then your sources of economic growth, obviously. Once again, supply side, demand side, you should recognize that your supply side is all your factors of production. How can we use those to ensure that we get economic growth? So this is really a full circle. We're going right back to the very beginning when we taught you these factors of production and why they are so important in our economy. Remember, at this point, you need to be able to discuss both quality and quantity and how they would contribute to growing an economy. Now, there's a load of discretion for us to use as markers if you are asked this question for a lot of marks, but there are some things that are absolutely critical, and that will be that you name them correctly and you identify them correctly. So do you know what are natural resources? Do you know what is labor, human capital? Do you know capital, man-made capital? And then do you know entrepreneurship? Can you describe them accurately? And then what you haven't come across before until now, this learning unit, is your capital widening and your capital deepening. There's usually a question on that, all right. And then your demand factors, you should be comfortable with as well. We've spent a lot of time looking at demand. Your problem here might be your import substitution. So just be sure that you know what we mean by import substitution. And that pretty much takes us to the end of part one. So we've done it in good time. That means we can go and take a break now. And I'll say to you, we'll come back at, I've said 10 past 11, but we'll come back in 10 minutes, which will be 5 past 11. And then we can go on and look at learning unit 1 through to 5 and anything there that you might want. If you are done for now, because these were the learning units you were worried about, good luck for the exam. Honestly, learning unit 1 to 5 is also important. Don't underestimate it, but you've already studied that. If you're not online students, you would have studied that for test 1 and test 2. Anybody who's online, obviously, you would benefit by sticking around because you haven't gone through those in detail yet. All right. If you've got any questions, I'm still around, so I'm happy to help you in the interim. Thanks, Josh, for your story there. Absolutely. Nice bit of advice there from Joshua when you're actually working through your exam paper, using your reading time productively for yourselves. Dean, I will be distributing the slides later on today. For my students, I will upload, obviously. Thanks, Joshua. And then I will share with the lecturers. So I'll send the recordings, the recording link, and then I usually also send a PDF version of the slides so that the lecturers can upload them onto ARC for you guys and girls. If your lecturer doesn't, then you can just send a message to them and request, could they please let you have the slides? Because they should all have them. It sometimes takes a little while, so by tomorrow morning they should be available, and then they should be able to make them available to you. Alrighty, for the last haul, let's see what we can do to help you get all of this into your heads. Hopefully what we're doing now is beneficial. I know that you've got a few other things to do before you get to economics, pity it wasn't economics on Friday, but at least you can re-listen to this if necessary over the weekend, and then hopefully it'll remind you of some of those important things that are necessary. We want to just take another look at the briefing just to see how that impacts or what the impact is for Learning Unit 1 through to 5. So here, looking again at our briefing, there's quite a lot of questions marks if we add them all up. So Learning Unit 1, 2, 3, 4, 5. Potentially there could be quite a few marks coming from what you've already studied for Test 1 and Test 2. That's why I always say don't underestimate. Just make sure that you fix all the mistakes. So any mistakes or any errors that you had for Test 1 and Test 2, just be sure you don't make those again, because often they're very similar questions that they can ask in the exam to what was asked previously, with the assumption that you will have fixed whatever the problem is, and now you should know the answer. So just do take some time going over and refreshing your memory of the stuff in Learning Unit 1 through to 5. I'm going to focus once again on the basics, and that means I don't always go into detail. The detail may be required in the exam, but I'm leaving that up to you to fill in. It also depends on your own memories. You know, at least if you can get a 3 out of 5, you're kind of halfway there. I'm sort of trying to help students get to their 60%. I'm not necessarily helping those of you who want your 80s and 90s. You'll dig deeper and go into more detail about a lot of these things that I'm bringing to your attention. All right, so let's go and get started with this. Back to the beginning, as they say. Now, something like this that you may or may not have seen before, and it has come up previously in an exam, but what it does is it forces you to accept that you know or you don't know your circular flow model. So it's a good practice, whether they ask this kind of question in an exam or not. It's really good practice for you because it tests you on a lot of the elements that come up in Learning Unit 1. The absolute critical bit of information here, folks, that you've got to be comfortable with is who are your participants, what are your flows, and what are your markets. And then when you're looking at your participants, remember they're also your spenders in your economy. So your participants are your households, your firms, your government, your foreign sector. A lot of students, I'll come into class, for example, when we were doing some of our revision, and I'll say, okay, give me the participants of the economic circular flow model. And students will say straight away, income, spending, production. No, those aren't your participants, those are your flows. What happened is they heard me say circular flow model, but they didn't hear me say participants. Be super careful, all right, when you are answering your questions. What are they asking you? And then when you look at flows, are they asking you for major flows, or are they asking you for flows relating to the financial sector, or flows relating to government, or flows relating to the foreign sector? What are they asking you? Because once again, students lose marks there unnecessarily. And then, of course, your markets. Are they asking you for your major markets, which is your goods market and your factor market? Or are they asking you for all three markets, which is goods market, factor market, and financial market? All right. All about reading that question carefully. And then being able to assess your flows. Where are they going from to? Are they injections or are they leakages? And then being able to use the information to answer a question that they ask you. So, for example, if we go back to those flows, and let's say I was asking you, what is the total value of flows relating to the financial sector? Then you would go in and you would tell me, well, we've got 80 coming from firms into financial sector, that's 80 savings. And then we've got from households into financial sector, also 80. So there we've got 80 plus 80, which shows leakage from the economy, savings, into the financial sector. We've got 140 going out of the financial sector through to firms, and we've got to know that that is investment. So it's been able to discuss them specifically in relation to the question that is asked. If we go to government, let's look at governments. We've got 320 going into the economy. That is our injection. That is our government spending. We've got 300 coming out of the economy into government. That is our taxes. That is our leakage. And then going through to your foreign sector, doing the same kind of exercise here. That 210 is going out to other countries. That means that is payment for imports. So that is our Z. It's going out. Leakage, and then we've got 230 coming in. That is our receipt for exports. In other words, we've sold our goods to overseas countries and the money is coming back to our economy. All right. So that's why I use this as a little bit of a learning exercise, because if you really spend time understanding how this works, you'll be able to deal with most of what they can ask you in this learning unit, whether it be from an application perspective or whether it be from a theoretical perspective. Then we go on to NB, what they always love to ask every single time, and that is stocks and flows. You've got to know the difference between stocks and flows. Nice, super easy question. Differentiate between stock variable and flow variable, or between stocks and flows, and then give examples of each. All right, so making sure you can do that. And then your leakages and your injections. You will get questions on leakages and injections. I don't know what it will be. I don't know how they'll ask it, but it will be there. So make sure you got this. All right. And this is what you have to know. Leakages reduce economic activity. Injections increase economic activity. Be able to tell us that, and then be able to give us a suitable example in terms of how savings will reduce economic activity, how investment will increase economic activity. All right. So making sure that you can take the examples and then put them into an intelligent explanation that will be able to give you marks for. Super important. All right. Make sure you know them. And then we go into the monetary sector. And here are the kinds of questions they can ask you on the monetary sector. So giving you a moment to look at those. Now, there are many other questions they can ask you as well, but these are typically the kinds of questions that come up, which are focusing on the core concepts, on what money is and what money does in our economy. And of course, you have to be able to answer them all. Let's go and have a look at some of the theory that you need in order to be able to answer these kinds of questions. First thing, can you define money? Straightforward question. Define money for 2 marks. You've got to be able to tell us it is anything. Remember, you can't tell us it's notes, rands and cents, or dollars and pounds. You've got to tell us that it is anything that is commonly accepted as payment for goods and services. All right, so watch out for that. Your functions of money. We assume if you can name them, you can describe them. If you can name them, a question 6 marks, discuss or describe the functions of money. You name them, you get half the marks. At least it's 50%, so not all bad. You want to get more marks, you've got to be able to describe them accurately. In fact, I think this question was asked in test 2, if I remember right, test 1, if I remember rightly. Then a little bit of a more tricky question, briefly describe the advantages of a monetary economy. And that was mostly, it makes transactions easier and smoother flows in the economy. But most important, it does away with the double coincidence of wants. All right, so that's one of your most important things we want to see if they ask that kind of question. And then other stuff would be acceptable. So as long as you're giving us something we can work with, we'd be able to recognize it. Now, students, we have not yet been tested on our monetary aggregates. It is my opinion that we will be tested in the exam on it. I don't know if it's going to be application or theoretical. It could be either, it could be both. But they love this question. So make sure that you are comfortable with your monetary aggregates in brief. And this is what I teach students when you are just using it for application. So if you are just going to be applying it, this is what you need to know. Some of this would be in your formula sheet because your formula sheet will reflect the formula that you use to calculate M1, M2, and M3. If we need it in theory, if they're asking you in theory, then you need a whole lot more. So please make sure you can do both. All right, so this would be, as I say, in full. So in brief, is what we need for application. Full, we need the whole bang shoot, the whole story, making sure that you can give me all of this information or give your lecturer all of this information. And then just remembering that M1 is your conventional definition for money or quantity of money. M2 is called broader definition. And then M3 is your most comprehensive because it covers everything. Because remember, M2 is equal to M1 plus additional, and then M3 is equal to M2 plus additional. Make sure you see how this comes together, because what happens here is I think students try to learn this off by heart, but they don't really see what the components of them are and how it works. Do 1 or 2 applications for yourself as well, just making sure that you're comfortable with how to calculate M1, M2, and M3. Your demand for money is your tricky section. Your demand and supply of money, your money market is your most tricky section. And this is where we are focusing on the fundamentals of economics. How does this market actually operate? Now, one of the problems here is that students often don't pay attention to the terminology. They selectively choose words and then they don't see that that is not what is actually being asked. And here you see a few of them in front of you now. First of all, you must obviously be able to define the demand for money. So I haven't put the definition here, and the definition for the demand for money is different to the definition for money. Watch out for that, because that's often something that students don't see. And then you see the question and you don't know which one is applicable, or you give me the wrong one. So make sure you can define the demand for money. Then you've got your basic components. What do we mean by components? It's what makes up the demand for money. In other words, why do you and me want to hold some of our wealth in a liquid form? What is it that it gives us? What benefit does it give us? Well, 2 benefits. Transaction, we can spend the money, and I can keep it as an asset. So these are your components. But maybe they didn't ask for the components. Maybe they asked you for the motives. Your motives are your transaction and your speculative. Now, there's a 3rd one in there for my students. Many other students wouldn't have got it, which is your precautionary. For now, ignore the precautionary, stick to transaction and speculative, and then be able to link transaction motive to active balances. You're going to do something with that money. You're going to spend it. That's why we call it active balances. And then your speculative motive is passive balances, because we're keeping that money on hand in case a good business opportunity comes along. All right, so be clear on how to differentiate between your motives, your balances, your components, and then be able to tell us what the determinants are. What is it that will determine the transaction motive or the demand for active balances? It is determined by income. Remember, that is what will tell us how much we have to spend. It depends on our income. What is it that determines the speculative motive or the demand for passive balances? That is interest rates. And that then, of course, brings us to our actual equation for the demand for money, which is L, which is liquidity, is a function of income in the economy, Y, and interest rates, little I. All right, so when we see that equation, L is equal to a function of, I know for many students, as soon as they see equations, kind of mental block sets in, because I don't want to deal with equations. But actually, these equations are so jolly helpful because they give us all the information that we need. Because it tells me now that the demand for money, which we've got to show as L, not as M or D or anything else, we show it as L, is determined by, that's what your F means, a function of your level of income, which we now recognize, Y, and your little I, which is interest rate. So it actually tells you a lot of information. And that means it's a useful little tool when you are studying. All right, so that's your demand for money. Then you've got to go and study your supply of money and what you must know. First of all, it is a stock. We talk about supply, but strictly speaking, it is a stock variable. And that is because it is measured at a point in time. There's no independent money supply curve because it is a stock variable. And then supply of money is said to be demand driven or demand determined. Make sure you know that terminology. And then we go into how money is created. In other words, how do we create this money supply or the stock of money? And of course, we've taught you that only banks can create money and that they do that by extending loans to credit-worthy clients and thereby creating new demand deposits. And if we take M1, the assumption is that we're looking at M1, which is C plus D. If C remains the same and D increases, there's only one thing that can happen. Money supply must increase. All right. So making sure that you've got that. And then only banks can create money. That includes the central bank. All right. And then also, how is the demand for money or credit regulated in the economy? And this is the role, of course, that interest rates can play in regulating that demand for money. Remember also that interest is the opportunity cost of holding money. So NB, although that hasn't come up in my slides here, which was very naughty of me because it should have been there front and center for you, the interest rate is the opportunity cost of holding your wealth in a liquid form, i.e. holding money. All right, super important for you to remember that. And then that brings us to, obviously, what does the graph look like for the demand for money? Now, in your syllabus, you learn 3 graphs. You learn what the demand for active balances looks like. You learn what the demand for passive balances look like. And they can test you on either of those or both of them. All right. So I'm not saying ignore them. I'm just focusing on what is most frequently asked. And most frequently, it is the money market equilibrium. And both in terms of explanation and in terms of drawing the diagram. How do we show equilibrium in the money market? Well, first thing, folks, we do not have a supply curve. You only have a demand curve. NB, make a note for yourself because it is something that it's easy to forget. As soon as you see that equilibrium, you're going to want to have 2 curves in your graph. It's natural because in almost every situation we've taught you, equilibrium has 2 curves. So it's going to be a natural thing that you want to do. You have to remind yourself that when we are looking at the money market, we only have 1 curve, and that is the demand curve for money. Inverse relationship between the interest rate, the opportunity cost of money, and the quantity of money that we will hold. When the interest rate is high, we will not hold a lot of money. When the interest rate is low, we will hold a lot of money. All right, so being able to see that relationship. And then how do we mark equilibrium? Well, we mark equilibrium by simply choosing an interest rate. So there we choose our interest rate. And once we have our interest rate, then we can mark that as our equilibrium. And how do we define equilibrium or describe equilibrium in the money market? It is where the quantity of money demanded is equal to the quantity of money supplied. All right. So being careful of this one because this is where we see students often go wrong. They give us the wrong graph because they put in a demand curve, correct? They put in their L curve, but then they invariably put in a supply curve as well. And that means you're wrong. And then, of course, you must be able to distinguish, as we always have to do, between a movement along the curve and a shifting of the curve. As I said to you earlier, for the Phillips curve, same old, same old. We've got to be able to tell the difference between those, all right? So what do we know? Let's see if you can answer some of these questions. Now, you don't have to answer on the chat, but just try and see if you can answer them at home. If you want to do the chat, that's also fine. Looking at the graph here, let's see what we can do with this. First one, a movement from E1, so we're going to go from E1 to EO, occurs when there is a decrease in the level of national income. True or false? You can just put a T or an F, depending upon if you're wanting to answer or not. Gonna wait for one more if there is another one before I comment. Well done, well done, well done. Great stuff. Students, you didn't fall into that trap. Absolutely. It is false, most definitely, because that is a movement along, and a movement along can only be caused by a change in the interest rate. Well done. Let's try another one. At EO, there is equilibrium. So at EO, there is equilibrium in the money market and at an interest rate of IO. True or false? At EO, there is equilibrium in the money market at an interest rate of IO. Well done. Well done. You got this. I get excited when students are getting it right. Super. Well done. Let's try another one. An increase in national income will cause a shift of the curve. So we've got now an increase in national income. It will cause a shift of the curve, yes, from L to L1. So there's our L to L1. Increase in national income will cause a shift of the curve from L to L1. Yep, we got this. Let's try the last one. See that we can get all 4 out of 4. Oh, Lordy, I don't know how to get rid of this little navigate thing. Yeah. Hopefully you can see it. It's in front of me, but hopefully you are able to see it. I think it says, and let me just check quickly on my slide here. Interest rate decreases. All right, so in case you can't see it, interest rate decreases from IO to I means that there has been, and I think it says, an increase in the cost of holding money. All right, so if interest rate goes from IO to I, it says there has been an increase in the cost of holding money. True or false? Yes, false, 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 because it's a decrease in the cost of holding money. Absolutely. Well done, ladies and gents. You got that. You won't have a problem. You've been able to distinguish between movement along, shifting of the curve. For those of you who maybe were confused and didn't know what's going on, you can see that some students do. Best you get there too before your exam, all right? And then we go on to another really important section here, and also based on the mark allocation that they've given us in the briefing, potential of questions from this, because these are super easy questions for an examiner to set. And this is the functions of the South African Reserve Bank. You've got to know the 4 main functions. Obviously, you must be able to identify the 4 main functions. But then what scares me a little bit, students, is them asking you for 5 marks, maybe just services to government. So now if they ask you to describe services to government for 5 marks, are you able to do that? Please make sure that if they asked you any one of these for 5 marks, you would be able to. Look, a provision of economic and statistical services, A little bit unfair for 5 marks because there's not really that much information there. But the other three, they can easily ask you for 5 marks or even more because there's a lot of information in each of them. You have to learn it, all right? You're not going to know it if you haven't learned it. So looking, for example, if we had to have a look at services to government, you know that you've got the different functions that come under your services to government. Make sure that you can actually list those. So like a banker to government, custodian of foreign exchange reserves, things like that, that you must be able to at least list each of the sub-functions that goes under each of your main functions, all right? It won't take you long, but it needs you to memorize. Otherwise, you won't remember it in the exam. The one that we obviously are going to do now, which you should therefore remember quite easily, is this one, because monetary policy is super important. So we're going to look at that in detail. And then NB, this one is often the one they love to test because it's critical for us. Maintaining financial stability is probably one of the key roles that the South African Reserve Bank plays in the economy. So it's a typical one that they love to question in detail as well. So all of them are important. Make sure you're comfortable with all of them. Can you define monetary policy? And notice here I say very NB. And the reason that I say this is very NB is because it's important all the way through the syllabus. We learned it in Learning Unit 2, but we have applied it again and again and again in various different contexts. That's why it's super important. If you didn't get it initially, you must make sure you've got it before the exam, all right? And be absolutely comfortable. What is monetary policy? Can you define it? Who's responsible for it? SARB and Monetary Policy Committee. That's your MPC, not your marginal propensity to consume, okay? This is your Monetary Policy Committee. Be careful because even I get caught with that sometimes if I'm not concentrating. And then your instruments versus your tools. Can you tell the difference between those two? Remember, your instruments can be market orientated or non-market orientated. We mostly work with market orientated. That's your accommodation policy and your open market policy. That is your market oriented. Then your others are your non-market oriented. We don't learn them in detail, but we must be able to name them. Then you've got your tools or your variables of monetary policy. They are different to your instruments. Instruments, tools, different. Have you noticed that? And then how is monetary policy used? Now you need to be able to explain expansionary or contractionary. And then how does it apply in the economy? So for example, if we said to you, there's currently high inflation, explain how we will use monetary policy to fight this inflation. First of all, you've got to tell me what sort of monetary policy we're going to use. So you would tell us we're going to use contractionary or restrictive monetary policy. We want to reduce spending in the economy, so we're going to raise interest rates. That will help to decrease the money supply in the economy, and people will stop spending, aggregate demand will decrease, and so price levels will come down. So you've got to be able to do all these links now. They could ask you, how can we use monetary policy to encourage employment in the economy? And then you've got to talk expansionary monetary policy and what and how that would lead to an improvement in the economy. People will spend more, interest rates go down, people will spend more, and if people spend more, then we will have a growing economy, and that means the level of income and production will increase, and if production and income increase, we're going to hire more people in the economy, so employment opportunities will increase. Being able to pull all of this together now is absolutely critical, all right? So that's your monetary policy part of the story. And that, just before I go zipping on to public sector, I just want to make sure if there's any questions from Learning Unit 2 that students might want to ask, because I really do think that this learning unit is super important for you. All good? And the reason I get particularly stuck on this one is because it's a lot of understanding. There's a certain amount of terminology. There's quite a lot that you have to learn here, but there's quite a lot of understanding. And often that understanding will conflict with the knowledge that you already have on money and how you see money in the economy. So I just want to be absolutely sure that you're all aware of any of those little tricky parts that you might have been struggling with. All right. Okay, brilliant. Public sector. Oh, this is a tough one. And the reason it's tough is because there's so much information. There's just a lot that you have to learn here. So once again, what is the shortcut? Go broad first. Make sure you know a little bit about everything. And then I'm going to try and highlight for you some of those things that are frequently asked and that often students have forgotten to learn. I don't know if it's because it's too easy or if there's too much information, but whichever way. Some of the questions that have been asked in the past from public sector, just have a quick look. And this is probably just a tenth of the questions that they can ask from here. So it's really hard for me to give you real guidance in terms of what could be super important here and what isn't that important. And that's what makes this particular learning unit quite a challenge. So I always say to students, go broad and then see how deep you can go. So first divide it into all the key sections that I've taught you to do, and then go in and have a look, how much can you remember feasibly of each of those. All right. There are certain important sections. For example, fiscal policy is absolutely critical, and I'll go through that with you. But there's just a lot of other information which they could question you on. All right. So we start off with asking you the components of the public sector. And that is making sure that you're able to tell us there's local, there's central, there's regional, and then there's public enterprises, or what we now know as state-owned enterprises. And then being able to give us a brief description on what happens in each. So what are the responsibilities of each of these levels of government? So they could ask you for the levels of government, or they could ask you for the components of government. Then the why. The why is a big one. And I always focus on it because invariably there's at least a question. It might only be 2 marks, but there's going to be something on why does government get involved in an economy, in the markets. And of course, the main answer is market failure. So that's your first step, is we know that market failure is a justification for government intervention. Look, many economists will argue against that. And certainly if you were going on to study economics at a higher level, we may expect you to be able to argue against it. But for purposes of first year, we teach you that market failure is one of the key reasons or justifications for government involvement in the economy. And then we teach you the different forms of market failure. So first of all, you must be able to tell us what is market failure. All right. So just make sure, if you haven't written it down anywhere, that you've got a definition or a description of what market failure is. And it is basically when the markets fail to allocate and distribute goods and services in the quantities and at the prices that are required by society. You might have a different one. I'm just giving you a very broad description. Whatever one it is, just make sure you've learned it. All right. Different types or forms of market failure. These are the 5 that we have taught you. Make sure you can describe each of them adequately, or recognize them, maybe even just as important. And then your other 3 reasons. So I always, when I'm teaching this to students, I say, first focus on your market failure, and then remind yourself there's another 3. So that you actually can separate them if necessary. Sometimes they don't require you to. They just say, what are the reasons for government intervention in markets? And then you can use any of these. It doesn't matter. But if they do ask specifically for market failure, then you want to stick to the ones that are linked directly to market failure, all right? At this point, I'm assuming that you kind of are okay with all of these. And if you're not, you'll go back and have a look. Look, there's a lot of information in the textbook. You don't need to learn all of that. You need one good sentence that clearly describes each of these as market failure. That's your key, is being able to describe it as a form of market failure. All right. You don't have to have all that information that appears in the textbook. Then we go on to the question they love to ask, and students get it wrong so often. And that is this 3 broad functions of government. What are the 3 broad functions? And sometimes I blame the examiners because they kind of mislead you a bit, and then they go and ask you for the 3 broad functions. They've led you down the garden path in some other direction, and then this is what they ask you. But please watch out for that. Your 3 broad functions of government: allocative, distributive, and stabilization. What they also like to do is give you a scenario and then see whether you can identify which of these broad functions is being spoken about. All right, so just be careful of that one. And that's your why. So we've done why, but then there's also how. How does government intervene? That is your instruments. And there's 5 of them, students. Remember, you already know 2. Government spending in the economy and taxation are 2 of the instruments that government uses to intervene in the economy. You already know those. Then a third one that you know just from your own personal life is regulation. We know that government makes rules and regulations that we've got to abide by. And then you've got another 2 that you must learn. All right. So 3 should be in the forefront of your mind anyway. And then make sure you learn the other 2. Describe government failure. Do you remember that there are 3 key concepts you've got to look at here? You can't tell us whatever you feel like. You've got to tell us those 3. And that's the behavior of bureaucrats, the behavior of politicians, and rent-seeking behavior. All right, so be careful there. Your reasons for an increase. Oh, this is the mean question. This is the big time sneaky question. This one, watch out for. We've given you, I think there's 5 of them, if I'm not mistaken. One, 2, 3, 4, 5 of them. Make sure you can give them the reasons for the increase in government spending over the past few decades. They're clearly there, bullet pointed in your textbook. Students always forget them. And I think it's because they're kind of obvious, but you forget to learn them. So watch out for that one. Can you distinguish between nationalization and privatization? Remember, nationalization is when takes over with or without private assets, with or without compensation. In fact, I think this question was asked in test 1, yeah, if I remember rightly. And then privatization is when government assets are sold to the private sector. So just be careful if you got that wrong in the previous test, make sure you sort it out. And then how does government finance its expenditure? Remember, there's 3 forms of finance. There's only 2 forms of revenue, but 3 forms of finance. We've got tax revenue, we've got other revenue or incomes, which is referred to as income from property, and then we've got borrowing. All right, so borrowing is not a revenue, but it is a form of finance. Be careful there, that you don't get into trouble. And then, of course, your fiscal policy, which I've already said to you. And the reason that, once again, it is so important is because we carry it all the way through the syllabus. Define your fiscal policy. What are your main instruments of fiscal policy? The budget. What are the main policy variables? Government spending and taxation. Why is fiscal policy, together with monetary policy, regarded instrument of demand management? Can you tell us? And then can you differentiate between expansionary and contractionary fiscal policy? And then, folks, can you talk about a budget deficit, a budget surplus, and public debt? All right, so they're not on the slides in front of you here, but they're still important, because if you don't understand what we mean by a budget deficit or a budget surplus, it means you don't really understand fiscal policy and how it impacts on the economy. All right, so you've still got to be able to do your budget deficit, your budget surplus, and then also your public debt. So just before we go on to taxation, I want to just remind you, because this is something I've picked up. I had assumed that students were clear on this, but because I've picked this up with students, I'm going to put something into the chat that I just want you to watch out for. All right. So remember, students often still make a mess with this. I'm not sure why. Remember that a budget deficit occurs when government spending is greater than taxes. All right, so if it's the other way around, if we've got taxes being greater than government spending, then we've got a surplus, a budget surplus. A budget deficit means that the government is spending more money than what they are receiving in taxes. NB for yourself. So write a note for yourself to remember, do I know what a budget deficit is? And then do you know what a budget surplus is? And then also understand that a budget deficit, an increase in the budget deficit, will lead to an increase in public debt. So if we are borrowing more and more money in order to finance our government spending, we are going to have an increasing public debt. All right. So being able to see those links, students, is super important. Once again, not because they're necessarily going to ask you a direct question on that, but they may ask you a question which requires you to understand those links and therefore be able to answer the question that they've asked. All right. So an NB for that, please watch out. And then, of course, tax. Oh, we all don't like tax much, especially when it comes to having to love the stuff literally off by heart, which is what you have to do in many cases. And there's a lot of information here. So once again, I've given you what is absolutely critical. That is making sure, do you know the difference between a direct and an indirect tax? Do you know general and selective? And then do you have an idea of progressive, proportional, and regressive? Now, that could potentially be a 6-mark question, so watch out for that. Are you able to describe each of those different tax systems correctly? Then your marginal tax rate versus your average tax rate. Can you differentiate between those two? This is all information that you have available, but you may not yet have paid attention to. So please make sure you can. Your capital gains tax, I've given you the answer because it's not always clear in your textbook what exactly capital gains tax is. So I've given you a bit of information there. And then explain why VAT is a regressive tax. Students, you were asked that, I think, before. Make sure you can answer it. All right, it could well come up again. Then I'm asking a few questions here where I've given answers. What type of personal income tax does South Africa apply? I do expect you to be able to tell us it's a progressive income tax, and then go on to explain what do we mean by a progressive income tax, depending upon your mark allocation. Then what are the criteria for a good tax? Being able to list them, equity, neutrality, administrative simplicity, and then being able to explain each of them. The 1 year, I think they asked just administrative simplicity for 5 or 6 marks. So they asked students to describe administrative simplicity as a criteria for a good tax for 6 marks. Can you do that? You need to make sure that you can. Otherwise, you're sitting with 1 out of 6 if you can just basically tell me what administrative simplicity is. So you've got to be able to give me enough information there to get all of those marks. Do you know what is a tax incidence? Simply where the burden of the tax rests or who carries the burden of the tax. And then, of course, can we shift the tax incidence? And then it depends whether it is the effective incidence or the statutory incidence. Remember, your statutory is who the law says is responsible for paying the tax. And then the effective incidence is who actually parts with the money to pay, out of whose pocket that tax actually comes. So I think that's the best I can do with helping you with this learning unit, because there is just a lot there that could be questioned. I'm hoping I've spotted a little bit correctly for you. But if you're looking for 80s and 90s, you want to go a bit deeper. All right. Last bit, but still NB. So your last 2 learning units, learning unit 4, learning unit 5. We'll get started on learning 4. We'll go through, I'll stop on the hour, then we'll take a 5-minute break, and then we'll quite quickly finish. So we'll probably be finished by, I reckon, about 11:30. So we've done, or 12:30 rather, we've done pretty good in terms of getting through all of the content. Well done to you, those of you who've stuck it out until now. Siasanda, that is a really good question. You do need to be able to calculate the tax, but it was asked in test 2. So they did ask the tax calculation in test 2. So I'm not sure. I would suggest that you do make sure that you can. And that's why I haven't focused on it now, because we did focus on it for test two. We made sure that you were all able to calculate it. I would suggest that you are still, because it's a super easy question if they do ask it. All right. So for your own sake, I would make sure that you can still calculate your taxes. And remember, students, if you were struggling with it, just go back to, if you've got the slides from test two, or if you've got your lecturer's slides, it really is not difficult. You just have to spend a little bit of time on it and you'll be good to go. We can talk about it more at the end if you like. All right, looking at the foreign sector. Also important, if I remember from the explanation there, where are they going to go with this one? I just don't know. So what are they going to ask? My guess would be the exchange rate, because it comes up usually in the final exam every time. But then you've got to also be careful of your absolute and comparative advantage, because they love to ask these questions as well. And I noticed they haven't asked much on it. So I'm kind of wondering if there is a possibility that it could be in the final exam. First step, make sure you can tell the difference between them. All right, make sure you know what is absolute advantage, what is comparative advantage, because that could be an easy, straightforward theoretical question that they ask you for 6 marks. Distinguish between absolute advantage and comparative advantage. Remember that absolute advantage, if they give you information on a country, we can see the information. We don't have to do any calculation. If they give us comparative, or they ask us for comparative information advantage from that information, we've got to do a calculation. All right. So just watch out and make sure you're comfortable with that. We'll put it to the test quickly. Here's Kenya and Swaziland. I've done the very first step with you, but I'm not asking you to do it now. I'm just asking you to make sure you can do these kind of calculations. And that is if you were required to here work out the relative comparative advantages for the two countries. Remember, if we asked you on absolute advantage, you can see that in the information. So let's have a quick check. Absolute advantage in the production of cocoa is Kenya. We can see they can produce more than Swaziland or Eswatini. And then in the case of beef, Kenya 140 and Swaziland only 60. So once again, absolute advantage goes to Kenya in the production of beef. So we can see that that Kenya has an absolute advantage in both cocoa and beef. And this was what made David Ricardo ask the question, why would this Kenya choose to trade with a country like Swaziland, which is much smaller and produces much less? And of course, it was by looking at the comparative advantage that they were able to work out the basis for trade. Now, remember, when we're looking at comparative advantage, we're looking at either or. So Kenya can produce cocoa or it can produce beef. Swaziland can produce cocoa or it can produce beef. This implies that if we're going to produce cocoa, we have to give up a certain amount of beef. If we're going to produce beef, we've got to give up a certain amount of cocoa. And that is what we are calculating when we calculate the opportunity cost. All right. So what we do is we give you a technique. Now, your lecturer's technique may be different to mine. You just go with whatever you've been taught. I'm quite happy with that. It doesn't, as long as you're getting to the right answer. The method itself is not prescribed. All right. And what I do is I say to students, you go into first the one country, Kenya, and you work out what is the opportunity cost of cocoa, 1 unit of cocoa, what is the opportunity cost of 1 unit of beef. You write it down. Then you go to Swaziland, you do the same. What is the opportunity cost of 1 unit of cocoa? What is the opportunity cost of 1 unit of beef? So let's go and show you what that looks like. There you go. So we've done the calculations for you. 1 unit of cocoa is going to cost me 0.12 units of beef. 1 unit of beef is going to cost me 8.6 units of cocoa. And I'm then able to do exactly the same for Swaziland. Now the trick comes. You've got to interpret this information. So you've got to remind yourself what you're actually looking for. And remember that you are looking for where the opportunity cost is the lowest. So there, where will I sacrifice the least? So for example, in Kenya, if I produce cocoa, 1 unit of cocoa means I have to sacrifice 0.12 units of beef. But in Swaziland, if I produce cocoa, I'm only having to sacrifice 0.08 units of beef. So that tells us that cocoa is actually cheaper in Swaziland. That is important when you are trying to interpret this information, that you read it correctly. That's your trick. All right. So ladies and gents, make sure you can do that accurately. And then here I've given you the interpretation. So making sure that you're able to interpret that answer correctly, and therefore whatever calculations you've made, you are able then to answer the question that is required. All right. So we've had a look at comparative and absolute advantage. Let's see in terms of timing, still got a few more minutes left. This one is going to be there in some or other way. Not sure if they're going to ask you a graph or whether they're just going to ask you theory questions on it, but they love to ask on exchange rates. All right. So super important that you are still comfortable with this section. Some of the questions that they can ask: explain with the aid of a graph the impact on the Rand US dollar exchange rate if Americans invest more in South Africa. Question number 2, identify 3 transactions that could lead to an increase in the demand for dollars in South Africa. What will happen to the value of the Rand in these cases? And then complete the following sentence by inserting the correct words or terms required. All of this relates to 2 key things you have to learn. What will cause dollars to be demanded in South Africa, or any foreign currency to be demanded in South Africa, which implies that those dollars or foreign exchange are going to leave the country, and what will cause foreign exchange to come into the country. That will be supply. All right, that is the question you ask yourself. So just looking at those first 2 questions, Americans invest more in South Africa. What do we know for sure? Dollars are coming in. Supply of dollars in South Africa will increase. If we look at 3 transactions that could lead to an increase in the demand for dollars, that is something that is going to mean you and me want dollars, and those dollars are going to go out of the country. So that is how you want to approach this, making sure that you've learned it accurately. And that brings us, of course, to this bit of information. Now, do we actually know what the exchange rate is? In fact, can we define an exchange rate? And then, do we know what the foreign exchange market is? Are you able to describe for me? Foreign exchange market is what we're looking at. We are not looking at the market for rands. All right. So when you draw your graph, you're looking at demand for foreign exchange, dollars, pounds, euro, whatever, and you're looking at the supply of foreign exchange. And notice what I say here. Situation where prices of currencies are determined through the forces of demand and supply. That is a floating exchange rate system. All right, that is what we study. Any transaction that takes Forex out of the country will affect the demand for Forex. So if you and me want to take money and invest it somewhere else, demand for foreign exchange. Any transaction that brings Forex into the country will affect the supply of Forex. People coming from America to South Africa or from Europe to South Africa, they are bringing foreign exchange into South Africa. It affects the supply of currency. That's your first step in understanding this correctly. And then we go on to the next step, is learning. What will cause the demand for dollars to increase? What will cause the supply of dollars to increase? You know this, you're going to be able to answer the questions. All right. So please, folks, and unfortunately, there's no easy way. It's just practice, practice and memorizing. And obviously, if you understand it, it'll make it a lot easier for you. But you've got to find a way to memorize this information correctly so that it can work for you. And then, of course, we go into the graphs. And then we ask you specific questions. South Africa imports more from the United States. In other words, we're buying more products from America. Or, for example, the price of crude oil increases on global markets. Both of these will have the same effect in the foreign exchange market in South Africa. In both cases, the demand for Forex is going to increase. We're going to see an increase in the price of the dollar on the foreign exchange market, and that will imply that the Rand has depreciated against the dollar in this case. All right. Don't forget to also read or explain what has happened to your equilibrium quantity. Make sure you've got that sorted as well. So that was an demand for Forex in South Africa. And then we go on to this one, exports to the United States. So we are exporting more to America, or American investors buy South African bonds. What do we see here? We see that the supply of Forex in South Africa increases. What happens? The price of the dollar decreases, and that means that the rand has appreciated against the dollar. All right, so you're looking at very easy graphs. Once you've learned all of that earlier stuff that I've shown you, then this should be easy for you to master, okay? The next step in this whole story is what happens in the rest of the economy. So once we've worked out foreign exchange issues, the rand has appreciated or the rand has depreciated, we then go on to have a look at what is the impact on the rest of the economy. So you've got this little table, 16-2 in the textbook. Now, they're not going to give you the table and ask you to complete it. Well, I say they're not, they could, but they don't usually. What they do is they give you a scenario, and you end up discovering that the rand has depreciated. So we now know that the rand has depreciated, and then they'll ask you, as a result of your answer, which was in this case depreciation, apologies, which was depreciation, what is going to happen to export prices? What is going to happen to import prices? What will happen on the current account? And what will happen to domestic prices? Folks, you got to know this. All right, so please make sure you go through this. It should be obvious to you. Once you've learned the information correctly and you start to join all the dots, as I always tell students at the beginning of the year, you've got lots of dots you've got to join, you'll get the picture. You'll understand what's going on here. All right, so have a careful look at this table. Make sure you understand it, and then make sure you can follow through. So if the rand depreciates, what's going to happen? If the rand appreciates, what's going to happen? What I often suggest here is the students learn just one, learn it and understand it really well. Then you can work it out. Because if you try and learn two, you're going to get confused. Whereas if you really understand what happens when the rand depreciates, then when it appreciates, you just reverse it and you'll be able to deal with that. All right. But there again, you must do what works for you. Another question that they quite like to ask, when the currency becomes volatile, there are basically three options that can be followed by the central bank. What are these? And that is do nothing, intervene in the foreign exchange market, or use interest rates to influence exchange rates. So this is a theory question, and they love to ask it specifically, like you see in front of you there, which is kind of, you can use all options, or they might go in and say, the rand is depreciating. What action can be taken by the central bank to intervene or to prevent this or mitigate this from happening? Now, you must know we would love to be able to intervene in the foreign exchange market by buying or selling Forex when we have a depreciation of the rand, but we do not have the foreign exchange reserves to do so. So be careful. That could be a trick question. Watch out for that one. We can use interest rates, though, to be able to influence or prevent further depreciation. And remember your relationship with interest rates and the value of the rand. Decrease in interest rates will depreciate the rand. An increase in interest rates will appreciate the rand. Make sure you got the link correct. All right. And then your terms of trade. Well, you can see from my story here, we don't often see it, but we do on occasion. So once again, there, make sure it's one slide. I think that's pretty much it. Can you tell us what is the terms of trade? And then what happens if terms of trade increase, the country's getting wealthier? Why? And if the terms of trade decrease, the country's getting poorer. Why? Can you answer those questions? And now what we're going to do is we're going to take a very short break. We'll make it 5 minutes, and then we'll come back and finish the last learning unit. I'm here if you want to ask any questions on what we've already done. But otherwise, out of here for 5 minutes. Joshua, do you want me to unmute you? Do you want to add? I should have unmuted you. I never thought about it. I've just kind of thought now maybe you want to add something in. Just tell me in the chat. Okay, let me. You should have told me and reminded me. I just didn't think of it. Just occurred now. Let me unmute you. All right, your mic. Yeah, so
Right. No,
there you
thanks,
go.
Tammy.
Shame. Sorry, Joshua.
No, I didn't want to overstep.
Yeah.
It's
No stress at all. It just didn't even occur to me, I have to tell you. So my sincerest apologies. I just suddenly thought now it might be nice for you to be able to chat or give some last bit of advice if you want to, when we're done with Learning Unit 5. Okay, brilliant. Okay. We'll be back soon.
cool.
Okie dokes, folks. Let's just do this last learning unit. And then I'll call on Josh to just give you some last minute advice as well. Anything that he thinks that is significant that I've not that I've probably missed out. But I'd also like to ask his advice then on Learning Unit 5 too, because there's a lot of stuff in Learning Unit 5 which can make it a challenging learning unit. It is my advice to most of you, though, based on the mark allocation that they've given us in the exam briefing, that you once again keep it broad. In other words, a little bit about a lot for Learning Unit 5 and focus on what we're going to show you today, which is the core concepts, all right? Because it would seem to me that there's not a lot of questioning that's going to come out of this, but it could be pretty significant if it does. So we want you to be equipped, at least for some of the basic questions that they could ask you on this learning unit, all right? And of course, that means we start with the fact that we're measuring the performance of the economy. That is what we're doing. And how do we do that? And of course, you've got to be able to describe to us each of the macroeconomic objectives. And then once again, as I mentioned to you earlier, is be able to distinguish between a macro objective and the tool that we use to measure that, or the indicator that is used to measure that, all right? So please do be careful of that. It's a super easy question that can be asked, and students often mess it up. And I'm not really quite sure why. So learn your 5 macroeconomic objectives, and then make sure that you can describe each of them. Now, what you're seeing in front of you here is not a description. It is just the tool that we use to measure that macroeconomic objective. So you need to go back to your notes or your textbook or whatever and make sure, can you describe to us, what do we mean by economic growth? What do we mean by full employment, price stability, balance of payment stability, and equitable distribution of income? All right, do not assume just because you can name it that you're able to describe it. Double check that, write it down if necessary. And then, of course, you must be able to discuss the different methods that are used to measure each of these macroeconomic objectives. The one that gives us the biggest headache is gross domestic product, real GDP, or GDP just in general. And in fact, not just GDP, it's actually the national aggregates, because we've got to know the difference between these different aggregates that we have. What does an aggregate mean? It means total. So when we are looking at the total economic activity, what are we looking at? We start off by reminding you that we need to watch out for double counting. In fact, we start off with the definition of GDP. You'll notice I haven't put that up. It was asked in the test. Many people were able to answer it correctly. So if you were, well done. You must still know your definition for GDP. All right, that's given. Definitions must always be learned. Do you know what we mean, though, if we say gross value added? Now, GVA, as it is commonly referred to, is still another way of referring to GDP. But we're being a little bit more specific. We're saying, how are we going to count the activity in the economy so that we can make sure that we are not including double counting? And we've taught you how to go about it using this little simple example. This is a snapshot of a sector in an economy. Let's say manufacturing or producing of bread. Where does it start? It starts with the farmer who grows the wheat. The wheat goes to the miller who turns it into flour, sells the flour to the baker bakes the bread, sells it to Pick n Pay, and Pick n Pay sells it to us, all right? And we've got two ways of looking at this information. You've got the value of sales, which is all very nice and looks so nice and big, but this does not tell us the value of the production in the economy. In order to do that, we have to eliminate the double counting of that 25,000. So in order to do that, we go and we do this little exercise. Your 25 was brand new, so there's no double counting there. It didn't exist before. Your farmer planted the wheat, and so now we have the wheat. But now he sold that wheat on to the miller. The miller bought that wheat from the farmer, and then the miller added his own value to it. What was it that the miller added? That was your 3,500. Then we ask the same question, what value did the baker add? And we see there the difference between 34,700 and 28,500. And there we see the amount is given for us there. Then we're going to do the same. What was the value added by the retailer? So when Pick n Pay packaged it, maybe in Pick n Pay packaging, or put it into their shelves and then sold it to us, what was the value they advertised it, arguably? What was the value that they added there? We've got the final amount that was added. And then what we have to do is be able to go in and see what was the total of the value added. So we add all of those together, and that is where we see that, in fact, we could just have taken that amount there. That is the value of final goods and services produced. All right. So just being aware of what it is that we're doing in this case. They can ask you to do this little application, but more likely it's going to be some sort of theoretical question which requires you to understand this. Then we go into what we call the conversions. Now you've got to know the difference between gross domestic product, net domestic product, net national product, and the difference between gross domestic product and net national income. So you've got to be able to do this. Now, you could have to do it theoretically, which means you may have to explain it. But what this little slide now helps you to do is do it both. You should be able to use this information to either do the application, which would require the calculations, or do the theoretical explanation if necessary. All right. So how do we get from gross domestic product, which is production by South Africans and all foreign people or all other people from other countries living and working in our country. How do we get from there to net domestic product? Well, the only thing that's changing is gross is changing to net. How does that happen? Well, we have to subtract consumption of fixed capital, commonly known as depreciation. This is the use of the buildings, the use of the roads, the use of all of that infrastructure that exists that we use each year. There's a value in that. So what we're doing is we're taking that out, because now we don't want to know about gross, we want to know about net. So we're going to convert from GDP to NDP. Then we want to convert further. We want to find out what is the value of net national product. Now we've taken out the consumption of fixed capital, so we've adjusted for depreciation. But now what we want to do is we want to adjust for all of the foreign factors of production that are operating in our country. We want to know what belongs to South Africa itself. So what step do we have to do now? We have to go and say, subtract primary income payments. That is to people who are working and living in South Africa but are not South Africans, because they can take their money out at any point in time. But then we also, as South Africans, are living and working abroad. We have South African citizens that are living overseas, and we want to add that back in. So that's what we're doing. And that will take us to net national product. And then NB for yourselves. Net national product is considered to be the same as net national income. So for purposes of our syllabus, we equate those two. Strictly speaking, not altogether the same, but for purposes of our syllabus, we say they are the same, all right? So this little slide hopefully will help you. If you memorize this, you should be able to work it out. As I say, both from a theoretical perspective and from an application perspective. This is the tricky one. It's a difficult one if they do ask you this question, and this is your difference between factor cost and basic prices. And the reason is that just for some reason, students find it difficult to remember. So once again, I would suggest you take your little story. I've done it differently to the textbook here. I've done it from the factory through to the customer. The textbook does it what I always call backwards. You may disagree with me, in which case, whichever way you've learned it, it's absolutely fine. But I prefer to go from the factory, which doesn't include any taxes or any subsidies, through to basic cost, which is your production. So what do we add in for the production function? And then what do we add in to send it through to the customer? And that just seems to make it a little bit easier for students to remember. And then if they ask you to go from market prices back to basic prices, then you know that you just look at those signs there. So if we're going to go backwards from market prices to basic prices, we must add back the subsidies and take off the taxes. All right. So I always prefer to do it forwards first, but as I say, students, you choose which one works best for you. And then you just learn one of the ways. Don't try and learn it both ways. Learn one of the ways. And then what you do is you work backwards if necessary, or forwards, depending upon what you've called it, all right? But just know the difference between, and sometimes that's the question they ask you. They don't ask you any calculations. They just say, describe or explain what is the difference between factor cost and basic prices. Then you want to talk to us about indirect taxes on production, subsidies on production. Or if they ask you what is the difference between basic prices and market prices, then you want to talk about indirect taxes on products and subsidies on products. So noticing those small little differences here, I think is what makes this a challenging section for students to remember. And then some of the questions they can ask you from this little section, this first section in Learning Unit 5, which is dealing with gross domestic product and all these different components, is this. Are you able to tell us what is the demand for the components of the demand for domestic goods? So if we're looking at this, what are we talking about? Now, the demand for domestic goods is C plus I plus G plus X minus Z. All right, because we want to, domestic goods are all the goods that are produced in South Africa. And therefore, we want to take into account the demand for exports as well. But we don't want to include the demand for imports because those are not domestic goods. So these are the challenging questions that you could get. Then how do you calculate domestic expenditure? This is GDE. So this is your GDE. Your GDE is just C plus I plus G. Then what comprises expenditure on GDP? In other words, that GDP that we generally talk about, what is it? Well, you should know it's C plus I plus G plus X minus Z. And then which concept is used to measure the returns on all South African-owned factors of production? Simple little question. What are they talking about here? Gross national income. All right, because this has got to be South African-owned factors of production. So you've got to be kind of careful. What are they asking you in relation to what you've studied? And then the easy one, what is the difference between net and gross amounts? That is your depreciation or your consumption of fixed capital. All right, so make a note of these for yourself. It's a good little test to see whether you've actually picked up some of the information you need from this learning unit. Example of calculation questions. I'm not going to stop now to do them, but I would suggest that whatever you have been given to work on, use them to practice with. All right. There's just so many different ways they can ask this. The previous exam papers are a good guide because often they repeat those questions in a very similar format. So that'll be a good guide for you in preparing for yourself for this exam. All right. And this is one of the questions that they did ask one year. Calculate the gross domestic product at market prices. And that was just taking C plus I. Remember, this reminds me, folks, gross capital formation. Remember that that is another name for investment. NB, don't forget that. So you've got C plus I plus G plus X minus Z. Where did we have? Oh, net exports. We didn't have Z. They gave us net exports. So they've already done the plus and the minus for us. And we can assume that this was a plus here if they haven't told us that it's a negative number. All right, so watch out for those little tricks that can happen in the questions. And then depending upon what else they ask you, you take what information is needed. But that's what's important. You'll have some guidance with the formula sheet because they will give you some guidance there as well. But you've got to know what's got to be incorporated in a conversion to be able to do it accurately. Do you know the difference between nominal and real? This is NB, NB, NB. You've got to know the difference between the two. Be able to explain that difference. And then your balance, and then we're at the end of economic growth. So if there's anything that I haven't covered, you can ask at the end if you think it's maybe important that I've maybe missed it out for whatever reason. Now we go on to balance of payment stability. Folks, I'm not going to spend much time on full employment and on price stability because you've done those in detail. We've done it, price stability, we've assessed in inflation, full employment, we've assessed with unemployment. So that you've studied a whole chapter on each of those. Doesn't mean they're not important, it just means we've basically covered them. So they're not absolutely critical. The one that is critical here, because I'm worried about students did poorly on this in test 2. So please, still, it is important. You've got to be able to tell us what is the balance of payments. You must also be able to tell us what are the accounts that appear in the balance of payments. And then can you differentiate between all these things here? Look, this one isn't so important. That one we can kind of take out. We don't have much on that. But all of this, the relationship between balance of payments, the balance on the current account, what is the trade balance, what is the significance of the balance on the financial account, and then what is the impact of the exchange rate on the balance of payments. Now, that is all stuff we've done in terms of looking at Learning Unit 5 when we studied it, but students didn't remember a lot of this, particularly the accounts that apply for the balance of payments. So please watch out for it. Yeah, you've got your definition, and then make sure, do you know what goes through the current account? Do you know what goes through the financial account? Do you know what goes through the unrecorded transactions? Or what is the purpose of the unrecorded transactions? Capital transfer account, we don't deal with much. It's not super, you must just be able to name it, but it's not super important. I just call that the emigration and immigration account, because if a person's coming into the country and they're bringing their assets with them, it's going to go through that capital transfer account. It's the same as if somebody's leaving the country and they're taking their assets out, it's going to go through that capital transfer account. All right. Your two most important ones, current account, financial account. You must be comfortable with both of them. And then that brings us to our very last little part in Learning Unit 5, and that, of course, is your equitable distribution of income. You were asked on the quantile ratio in test 2, and many students were unable to answer that question. Ladies and gents, it could be there again. Make sure you can do your Lorentz curve, you can do your Gini coefficient, and you can do your quantile ratio. You can describe them, you can apply them if necessary. And then you should be able to deal with any question that they do ask you on that. I'm assuming at this point that people are comfortable, that you know this, and then hopefully for all of you, success. And so now I'll call on Joshua to add in a little bit of additional information. I'll quickly answer Kayla's question. Yes, Kayla, gross capital formation is the same as investment spending by firms. Absolutely. All right, Josh. Do you want to add that, your last words
My
of
last
advice?
words. Thanks, Tammy. So last words of advice is, yes, we know it's a lot, but you've been working on this throughout the semester. So really do focus more on those last chapters, but you see now that how some of them are interlinked with each other. Particularly this Learning Unit 5 one interlinks a lot with those last few chapters. So there's some information that needs to be recalled from these chapters as well. So when you're sitting there in your exam reading time, Get comfortable with the paper, be confident in yourself, and then clearly identify in that section C, please, which of the 3 questions you're going to do. Don't then start question 1 and then start question 2 to then realize, you know what, I don't want to do question 2, I want to do question 3. Try keep it together for us from a lecturer's perspective in terms of marking, because it just makes it a bit easier. But yeah, the formula sheets will help, but it's still good to know the formulas and be able to interpret what is there, you know. Yeah, so that's my final say on it. And yeah, you've got this. And do your practice as well. You know, don't just
Absolutely.
go look at the solutions, because we see it. I can see when there's students that just write something down and it's just because they saw it somewhere in a past exam or whatever, but they're not actually answering the question. So read the question carefully, see which learning unit, what are they trying to ask me here, stick to the mark allocation. Do not write a whole page if the thing is only 4 marks, please.
Yeah, absolutely. Thanks, Josh, and good luck to you all. If you've worked hard, I promise you, you will be rewarded, because the exam isn't that bad for students that have really put in the effort. It can be an unmitigated disaster if you haven't put in enough time and effort. But for those of you who've done your work, I think you'll find you will be rewarded in that final paper. I see that a student has said, could you possibly post the slides to the chat? Well, if I knew how to do that, then I'm happy to do it. So if anybody's got any advice as to how I do it, Joshua, do you know how I do it?
Yes, Tammy.
Yeah,
I was also thinking that,
yeah.
So in the chat box, do you see the plus icon?
Yeah. Well, hold on. Let's see. Yes, I see the plus. Yep.
And
I
then
got it.
there should be
All right. It's coming up now.
attach.
So it's being a bit slow. So
Yeah, I
let's just
see it's
see
slow
what
on
it
my side
happens.
as well.
I know sometimes if you've got apps and stuff, then obviously it does make it, because it
Yeah,
says
no,
get
I see
apps
this
and
one is
stuff.
because
Yeah.
I think it's also because this meeting is not a normal meeting. So it
Yeah.
treats as an event. So you can't add it unless you can just try drag and drop the slides into the chat.
Let's try. Let's have a look and see if we can.
Drop the PDFs in there and see if it
Yeah.
opens.
I just haven't PDF'd. That's the only thing. So I'll tell you what I will do in response to it. I think because the chats continue after I won't exit. What I'll do is I'll go back to the chats, which should be recording some of the chats of this meeting, and then maybe it'll allow me to put it in there, because it's just
Well,
not
it
doing
should.
anything
And
on
the
this side.
students then that did sign on with their student accounts, then they're still able to access
Yes,
the
they
chat.
still should be
But
able to access it.
the external ones,
Just let me
unfortunately,
just
not.
see if I go here, this meeting chat. Yeah, because it's still going round and round and round and round, and it's not actually doing anything. Yeah, it just says to me it's not responding.
Okay.
All right. So
Tammy,
sorry,
all the
sorry.
best. I need
Yeah,
to answer
I'll
another call.
see.
Thanks, guys. Good
Yeah.
luck.
Yeah, absolutely. And cheers to you all. Good luck. And thanks, Joshua, for joining. It's always nice to have some company on this. Um, but I'm going to stick around a little bit. I'll just wait for everybody to go. And then what I'll do is I'll pop across to the chat, see if I can upload, but otherwise I'll distribute them. All right, Chiara, I'm not sure some of these questions which I missed because I was fiddling around on the chat here. If you can hear me, what happens is we send the link to National upload it onto YouTube, and then they distribute the link. So the YouTube link will be distributed probably by tomorrow, I would estimate, because I'll send it through today. And then they'll put it through. Let me just stop the recording, actually, because we don't need all of this to be recorded as well. So we'll stop the recording now. Yeah, so it should get to you at some point. As I say, you might